Stocks bounce, global equities rise, oil rebounds, and U.S. futures point higher as a new trading week begins. Is Wednesday's U.S. inflation report the next big hurdle? Policy shift. The Trump administration says it's willing to engage in nuclear talks with Kim Jong-un. Could discussions at the Winter Olympics lead to a thawing of relations with the North? And D-Day nears for Zuma. The ANC prepares to finalize the transition of power away from South African president who held office for nearly a decade. Could this be a turning point for the country? So good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, what a week we had on the markets last week. So this is, I guess, the tension as we get onto Monday and then the CPI report on Wednesday. This is what I'm looking at in terms of stocks. Now, they're getting some 1.6%. This is for the European stocks. We're also seeing futures in the U.S. pointing to a higher open. However, if anything taught us last week that things can reverse quite quickly and they can actually change quite quickly. So look out for any volatility. You can see the VIX index down some 10%, and you can see Eurodollar 122.76. As we were saying last Friday, if there is an infection beyond equities and beyond the VIX, it would be in credit markets, so watch out for that. Also coming up on Bloomberg Surveillance, we talk markets and last week's correction with Andrew Sheets from Morgan Stanley. And then a little bit later on, we also talk to Eric Nielsen, the chief economist at UniCredit. Plus, we talk ECB and Brexit with the Maltese finance minister. Now, let's get straight to the Bloomberg First Word News. Here's Nara Chait. Hi, Nara.
Hi, Francine. The U.S. says it's ready to engage in nuclear talks with North Korea. Speaking to the Washington Post, Vice President Mike Pence dubbed the new strategy maximum pressure and engagement at the same time. The comments, which signal a shift in American policy, came after Pence and South Korean President Moon Jae-in agreed to pursue a dialogue with Pyongyang during conversations at the Winter Olympics in Pyeongchang. Meanwhile, Budget Director Mick Mulvaney has warned that the U.S. will post a bigger budget deficit this year and could see a spike in interest rates as a result. But he says cutting the spending shortfall over time is possible based on sustained economic growth from President Trump's tax cuts. The White House is expected to release its 2019 spending proposals today, which Mulvaney says will include a plan to cut deficits by $3 trillion over 10 years, though a preview of the document didn't state how those cuts would be made. The Israeli fighter plane that crashed on Saturday was likely hit by a Syrian anti-aircraft missile. That's according to an Israeli army spokesman. The F-16 was hit after Israel struck an Iranian control base near Palmyra in Syria. It's the first time Israel has lost a combat plane to enemy fire since the 1982 Lebanon War. In just 1 week, Ray Dalio has quadrupled his short bets against EU companies. The bloc's regulatory filings show Bridgewater Capital has at least $13 billion in shorts. The hedge fund's biggest bearish position of more than $1 billion is against oil giant Total, with further bets against BNP Paribas, ING and Banco Santander. Angela Merkel says she's determined to serve another full term as German Chancellor, rebuffing party politics who accuse her of selling out to the Social Democrats to stay in office. Merkel urged SPD members to back the coalition deal in next month's vote, which would allow her to form a government after more than 4 months of deadlock. South Africa's ruling African National Congress meets later today to finalise the transition of power from President Jacob Zuma. ANC leader Cyril Ramaphosa has told supporters that the party must resolve its problems, including accusations of corruption against Zuma. Ramaphosa replaced the president as ANC leader in December and is expected to succeed him in the presidency as well. London City Airport says all flights are cancelled on Monday after the discovery of an unexploded World War II bomb in the River Thames. The police and Royal Navy have established a 200-metre exclusion zone around the device, which was found during planned development work. The airport has advised all passengers due to travel on Monday not to go to the airport and instead contact their airline for further information. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nara Chait. This is Bloomberg. Francine.
Thanks so much, Nara. Now, we are just getting some breaking news out of Airbus. Airbus issuing a statement on the Pratt-powered engines of the A320neos. Now, we did see a couple of concerns earlier on. Airbus now saying that 30% of the Pratt-powered A320neos have indeed faulty engines. 30% means it's almost 1 in 3. And the most important aircraft for Airbus, we were told, over and over was the A320, and it just can't shake its teething problems. So it has been already forced to suspend some deliveries of its A320neo jet following another issue with these engines. For example, Indigo, the Indian low-cost airline, that's the plane's biggest customer, yesterday disclosed 3 in-flight shutdowns, said pilots have had to turn back before taking off in 3 other instances. And that was an alarming new problem for a power plant that's been hobbled by glitches from the start. You can see Airbus down some 0.9%. Now, investors are getting a reprieve onto the markets now, and investors are getting a reprieve from the recent turmoil this morning, with global stocks recovering from their worst weekly rout since 2011. Now, the Stoxx 600 is up strongly in Europe this morning. Now, the unwinding of the short VIX trade was one of the biggest casualties of the correction. The blow-up in volatility has sparked a shift in the futures market. VIX futures spiked to a record net long last week, and traders are now eagerly awaiting Wednesday's U.S. inflation data, which has the potential to really move the markets again. But with Treasury yields on the rise, can the gains actually hold? Well, for more on last week's correction in the markets and what to come, we're joined for the hour by Andrew Sheets. He's Chief Cross-Asset Strategist at Morgan Stanley, and Peter Dixon, Global Financial Economist at Commerzbank. Also joining us is our markets and quants reporter, Danny Berger, who's been following this very closely. So welcome to the program all. Happy Monday. Danny, thank you so much for coming in. So is this shift in position a sign that actually investors are preparing for a new reality?
Well, there was certainly a really large buildup of short volatility positions. So this is a little bit healthy that we're seeing a move away from this. I mean, it's quite shocking when you look at how drastic this move is. I mean, the most record net longs that we've seen, most of that is driven from a reduction in short positions. But there was so much money behind those short positions, which really got burned last week. Because when you think about it, that is the trade that had been essentially minting money for the past few years. Volatility has been so breathtakingly low. And now it seems investors, perhaps some just because of the damage they sustained, needed to take off those positions. But also as we get more inflation data rolling in, as we see some weakness in credit markets, there certainly are signs that perhaps this facade of stability has cracks in it, and we could expect more volatility to come.
So, Danny, in our reporting, have we figured out exactly who are the winners and losers in the correction, if you want to call it that, last week?
Sure. Well, certainly people who are holding the VIX ETPs, definitely a loser in this situation. But I actually spoke to a hedge fund based in Denver, and this was more of a joy to report.
That was a great story.
Thank you. Well, it was great to report because we've talking to so many investors who really were hurt by the blow of the ETP. So it was a nice change of pace to talk to someone. So they had a put on SVXY, one of the short volatility ETFs, netted a $17.5 million gain from a $200,000 bet on that put. So that certainly treated them well. But if anything, that shows that warning signs had been out there. Whether investors were willing to listen to it, though, was a different story.
Yeah, and that's often the case, which is why we often talk about the canary in the coal mine. But actually, Andrew, what will this week bring? A lot of people called the end of the volatility on Wednesday, and then on Thursday it tanked again. And so people are a lot more cautious, also seeing whether this infects other markets.
Yeah. Well, look, I think actually it's important to step back and say that the move we've had so far is actually similar to a number of the sharp drawdowns we've had in this bull market. Initial sharp drop, a retest, we had that at the end of last week. Volatility peaking relatively early on in that correction process while markets remain volatile, and I think we're still on track for that. I think, what's interesting is that at the end of last week, you finally had some of these other lagging asset classes finally catch up. But their repricing also matters. In credit indices, you're now back to closer to the one-year wides. Same story in emerging market credit. So, a number of these asset classes have repriced. And I think that kind of puts us in a healthier place to find a base and ultimately to move higher.
Okay, but credit hasn't really repriced, has it?
Not yet. But there's a lot of scope for it to do so because obviously credit is going to depend very much, I think, on A, the macro environment, and B, what happens with regard to central bank policy. We're in a situation now where central banks are clearly not providing the support that they once did, or at least will not provide the support that they once did, further down the track. And I think we'll start to see a number of markets repricing, credit being one of them. I'm not expecting a major crack, but continued widening would be my guess from here. Okay,
are you expecting a repricing in credit, and how ugly would that be?
Well, so I think it actually depends a lot on the instrument. So it's a fair point. The cash market, corporate bonds themselves have repriced relatively little. But the credit default swap market, the more liquid indices have moved more, especially in the U.S. So, again, I think some normalization of that would make sense, that maybe the indices have made the majority of their move, that's now done, but that the cash market, which has budged relatively little, I think absolutely should respond to some of this higher volatility environment, this greater late cycle concern, and that probably should underperform a bit.
Let me bring over to my chart, which is my chart of the hour, if not the day. And this is basically a very simple S&P 500. Thank you for Dan Kirstis, who's stepping in Hillary's shoes and giving me a lot of these charts. And it's basically the S&P log scaled with 200 and 100-day moving averages. And we get drop below 200-day moving average, but it closed back above. Dan, if you look at some of the fundamentals or some of this tick, again, you were saying that this volatility is also pent up, no volatility for 18 months. Is it difficult looking at moving averages and these kind of technicals to see what comes next?
Right. Well, I mean, moving averages sometimes become sort of a self-fulfilling prophecy. I, for one, don't tend to look at them, but looking at momentum is important. And we did have a sharp reversal in S&P 500 momentum. Trend followers, CTAs, definitely hurt last week. And when we look again at credit markets, seeing what areas have been hurt, the ETF credit market, I mean, talk about some bearishness, or if anything, just some protection. Short interest has skyrocketed. Derivatives trading looks particularly bearish right now. J&K, State Street's junk bond ETF, had the most outflows last week on record. So certainly there are some nerves around risk assets right now.
Okay, what does the, do you look at moving averages at all?
Well, I think we do, I think for the same reason that other people look at them. I think it's one of those funny things that statistically they mean actually very little. But in certain instances, they can be very important.
Because of psyche.
Because exactly. I think in instances like this, right, all of us are looking for any sort of anchor, any sort of demarcation line that will help. And look, I think it's important that if we look at how futures in the S&P traded, right, they traded off significantly between Monday night and Tuesday morning. They bounced off that low. They retested that low late last week, and they bounced off it again. So I do think that there's some comfort that will be taken from traders in the U.S. that the S&P has completed that retest, and that will be taken, I think, as a positive technical sign.
Peter?
I tend to agree. I mean, the moving averages, as Andrew says, they give us some information. They tell us about momentum. And I know chart technicians use these and look at them very, very, very carefully, scrutinize them very closely. I'm not entirely sure always what they're telling us. At the moment, what they're telling us is that the market corrected. Yeah, big deal. We kind of know that. That was a necessary correction. But as you said,
But no one got the timing, or very few people got the timing right.
It's virtually impossible to get the timing right. I mean, I think we've been saying for months, how long have we sat here and said markets at some point are running way ahead of themselves? We can't predict the timing. We don't know why it happened exactly. But, we saw that spike in volatility, but volatility is coming down again. And we've been here before. This is 2015 in replay.
All right.
For that reason, I remain reasonably confident that we'll get over this.
I mean, people should really watch surveillance more often. Thank you all. Andrew Sheets there from Morgan Stanley, Peter Dixon from Commerzbank, and thank you to Danny Berger, our markets and quants reporter. Now, stay with surveillance. Plenty coming up, including a shift in U.S. policy. America says it's ready to engage with North Korea about its nuclear program. Does that mean the country's charm offensive has worked? Well, we're live in Seoul. Plus, oil bounces back, but concerns about U.S. shale output cast a cloud. Will it undermine OPEC's efforts to clear the glut? We'll get reaction from the Middle East on the price of oil. This is Bloomberg. Markets, economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the U.S. says it's ready to talk to North Korea about its nuclear program. Comments by the Vice President, Mike Pence, signal a shift in American policy. Now, he dubbed the new strategy a, quote, maximum pressure and engagement at the same time. For more, we're joined by Peter Pei, our Seoul Bureau Chief. Now, Peter, thank you so much for joining us this morning. So there's been quite a shift in policy. Is it a real shift, or is it just optics?
Well, that remains to be seen. At this moment, it sounds like real, mainly because, I mean, really, U.S. had no choice other than to alter their shift. They were left in a sticky situation with South Korea, which over the weekend got an invite to have a summit with North Korea. And of course, South Korea was also in a bind there because they didn't know what to do in regards to, if they did have the summit, that would put U.S. and their alliance in an awkward situation. So, it sounds like U.S. is trying to bridge that. This actually a pretty brilliant move by North Korea by making that invitation, trying to put a wedge between U.S. and South Korea, and obviously U.S. does not want that to happen. and they came up with this policy shift, which will remain to see how that goes.
So, Peter, what's next for South Korea? And did North Korea's charm offensive have an impact on this?
I'm sorry, could you repeat that?
So my first question, what happens to South Korea? And of course, North Korea sent the sister of the leader to do the charm offensive. Did that work?
Oh yes, very well. In fact, I think if you ask anybody on the street here, they would say that her visit to South Korea, which was, by the way, the first time that a Kim dynasty bloodline stepped on South Korean soil, so it was very historic. That basically her presence overshadowed the opening ceremony, the beginning days of the Pyeongchang Olympics here. Basically, all her movements, even analysis or analysts describing her looks, the freckles, the plain hair, the way she carried herself, the way she smiled, pretty much took up the newscast for almost 3-4 days. So this is, the charm offensive, as people are calling it, was, I would say, a grand slam.
All right, Peter, thanks so much. Peter Pei there, Bloomberg's Seoul Bureau Chief, joining us this morning. So the situation in Korea seems to be cooling. How should investors be playing geopolitical risk? Still with us, Andrew Sheets from Morgan Stanley and Peter Dixon from Commerzbank. So thank you both for sticking around. We can bring it like a million ways. We can either talk about geopolitical risks and what it means for the markets, but we can also talk about, some of the travails in the Trump administration with, things inside the White House and this infrastructure plan. I mean, what will dictate the markets? Is it the kind of, the spending and the deficit in the U.S., or can geopolitics also be at the forefront?
Well, I think what's really interesting over the last real month is I think that question of spending has really gone to the forefront. There's obviously also been some more aggressive moves on trade. I think that's in the background. But, I think what's been quite notable is throughout the month of January, you had this real steady rise in the implied real interest rate on the U.S. 10-year, right? The yield less inflation expectations. And I think that was consistent either with expectations of tighter policy, but also more borrowing, kind of higher risk premiums on U.S. debt. And I think that was also coming at the same time that it seemed like spending proposals were continuing to increase, that the new budget no longer aims to eliminate the deficit in 10 years. And I think this is a greater focus for investors and is something that's going to be with us and in the background of markets throughout this year.
You agree with that, Peter?
Yeah, to a broad degree, yeah. I mean, obviously, the fiscal stance has been very much to the fore. Now, of course, we have something concrete to work on, which is good, because I think we spent most of last year worrying about what the scope of that fiscal stance would be. But going back to your original question, do we worry about geopolitics? Probably not. I mean, I think if you look at things, the way the markets have been going over the course of the last few months, the worries have been purely based on fundamentals, sentiment, expectations of interest rates, all that kind of thing. So, geopolitics, I think, will probably continue to play a background role in markets thinking throughout much of this year, unless, of course, the unexpected happens. But that's always the case with markets, right?
So, the unexpected would look like a threat of nuclear war, and the markets don't know how to price it.
You could have something like that, but I mean, that's a real tail risk. I mean, I'm thinking more in terms of some kind of saber rattling over China. Right. We know of their expansion into the South China Sea, for example. Is that going to cause any concerns with regard to trade talks, for example? Will there be some response on the trade front, that kind of thing?
What's a haven right now, Andrew? Is it still, I mean, I ask this question every time, but is it still yen?
So I think the yen should have some of those properties. We like the currency. We think it's inexpensive. We think it will be negatively correlated to risk if there's a broader risk-off sentiment. I actually think for the full year, I think Europe is going to be a pretty attractive place to be. I think the political situation looks relatively good, certainly by the standards of the last 5 years. The economy is very strong. I think the central bank is going to have an easier time than some of the other central banks globally in remaining a little bit more dovish. And both the currency and the stock market are cheap. So I think Europe is actually going to be a pretty attractive global place for investment.
Okay, we're going to talk about Brexit in a second, but are you not worried that euro creeping up is actually a real concern for ECB?
So I think it's a concern, but one, Draghi has been vocal about that. I think second, secondly, European equities have three other big tailwinds coming behind them. The banks are finally becoming profitable again. The energy sector and the commodity sector is benefiting from a large rise in commodity prices over the last year. And Europe has a lot of exposure into EM. EM growth broadly is also improving. So yes, the stronger euro is a headwind, but we think that those other tailwinds will ultimately outweigh it.
Peter?
Yeah, I think that's right. I mean, I think with regard to Europe as a safe haven, it's kind of the best of a bad job, really. I mean, many of the problems, I think, which have afflicted Europe, they're not to the forefront now because other things have overtaken them, but they're still there. But we are seeing, I think, signs that Europe is trying to be a bit more serious with regards to building a proper monetary union, the Macron plans, etc. So I think that's giving investors some hope. So yeah, I think I'd probably agree with Andrew that given the alternatives out there, Europe's not such a bad place to be.
The one other thing I might just say on the U.S. is I think what makes the U.S. deficit and the budget situation so hard to analyze is there's just so little precedent. Right, the U.S. is probably going to run a deficit of 5% of GDP while unemployment is below 4%. Right, you haven't had that combination, anything close to that since the late 60s. So I think this is something that we fundamentally struggle with: is how to quantify something that markets just haven't seen in a long time.
Okay, let's also focus on the UK. Senior UK ministers are preparing to deliver a series of speeches as part of their roadmap to Brexit. Now, the schedule begins on Wednesday with the Foreign Secretary Boris Johnson appealing to both sides of the debate. Prime Minister Theresa May is then expected to offer new security relationship 3 days later when she addresses a conference in Munich. So how will clarity on the Brexit issue move the markets, and what's next for the Bank of England? Peter, I guess my concern is that we were surprised, or the market was a little bit surprised about the customs union, the fact that they would completely abandon it. But then I spoke to Ian Duncan-Smith on Friday, and he said, well, of course not. That was always the case. I mean, are the markets, first of all, listening to certain members of the cabinet? Who do you listen to, right? Do you listen to Theresa May, or do you listen to a hardliner such as Ian Duncan-Smith who puts pressure on Theresa May?
Well, I think you listen to all of them, but you don't necessarily take them all at face value. That's the problem, because, I mean, Theresa May is caught between a rock and a hard place between the Leavers and the Ultras, the Ultras and the Remainers. And the problem is that, there's a sense out there, I think, that the ultra leavers get a big press and they seem to dominate the agenda because they're offering something different, but they're not actually offering a policy. And what we're looking for from the UK government is some, I think, clear evidence, some clear signals of what they actually want from the agreement with the EU 27, and of course that is exactly what the European governments are asking for. And at the moment there is as little clarity as there was maybe 12 months ago.
Okay, so what does it mean for the Bank of England? Right. I mean, a hike can first of all, do they need to build ammunition so that they can react if something turns sour, or is it too dangerous to go for a hike at the moment?
Well, I don't think it's too dangerous. I mean, I think if we look at the impact of Brexit on the economy, yes, it has taken some of the edge off growth for sure. So the economy is underperforming, but Brexit's going to be a slow burn, I think, in terms of what it does to the UK. It will be, underperformance for a period of years. And under those circumstances, I think the bank can justifiably say, look, we don't need quite the same degree of monetary easing as we put in place in 2009. We can take some of it back. So, rate hikes are certainly on the agenda, and I think that was the message that we got from them last week.
Andrew, do you buy any UK assets at the moment, or do you wait and see do you buy on the dip?
Well, look, I think that if we look at something like the UK equity market, which is trading at the largest discount of really almost any global market relative to global equities, I think you can argue, look, there's a risk premium there, there's an uncertainty premium there. I think we're a little bit more cautious on the pound. It's run up quite considerably. There is still a lot of uncertainty there. Our FX team is expecting a little bit more near-term weakness, but I think that's a key point. There's still, I think, a lot of unanswered questions here, and to really narrow that discount on UK assets, the market wants to see that certainty.
Okay, thank you both. Andrew Sheets there from Morgan Stanley and Peter Dixon from Commerzbank. Both stay with us. Now, coming up, we talk oil. Oil bounces back after its worst week in 2 years, but is shale production in the U.S. holding back further gains? Now, we discuss that, and of course, we look at your markets. If you look at some of the trades, now, record selling in the SPDR S&P 500 ETF. Bear with me. We do have a chart for this, but it is one of the funds that was oversold last week. Well, some of the signals there is basically showing that the worst is over for now. However, it still trades more than twice the price of the iShares 20-plus year Treasury bond ETF. So what that means is that there may be a little bit of pent-up demand, and that leaves ample room for the ratio between the two funds, which closely track the cash S&P 500 to return back to its 5-year mean. That means look for rotation. We'll discuss that next, and this is Bloomberg. Markets, economics, finance, and politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Nara Chage. Hi, Nara.
Hi, Francine. The US says it's ready to engage in nuclear talks with North Korea. Speaking to the Washington Post, Vice President Mike Pence dubbed the new strategy maximum pressure and engagement at the same time. The comments, which signal a shift in American policy, came after Pence and South Korean President Moon Jae-in agreed to pursue a dialogue with Pyongyang during conversations at the Winter Olympics in Pyeongchang. Meanwhile, Budget Director Mick Mulvaney has warned that the US will post a bigger budget deficit this year and could see a spike in interest rates as a result. But he says cutting the spending shortfall over time is possible based on sustained economic growth from President Trump's tax cuts. The White House is expected to release its 2019 spending proposals today, which Mulvaney says will include a plan to cut deficits by $3 trillion over 10 years, though a preview of the document didn't state how those cuts would be made. Angela Merkel says she's determined to serve another full term as German Chancellor, rebuffing party critics who accuse her of selling out to the Social Democrats to stay in office. Merkel urged SPD members to back the coalition deal in next month's vote, which would allow her to form a government after more than 4 months of deadlock. South Africa's ruling African National Congress meets later today to finalise the transition of power from President Jacob Zuma. ANC leader Cyril Ramaphosa has told supporters that the party must resolve its problems, including accusations of corruption against Zuma. Ramaphosa replaced the president as ANC leader in December and is expected to succeed him in the presidency as well. London City Airport has been closed after the discovery of an unexploded World War II bomb in the River Thames. The police and Royal Navy have established a 200-metre exclusion zone around the device, which was found during planned development work. Carriers, including British Airways and CityJet, have cancelled flights. London City Airport advised all passengers due to travel on Monday not to go to the airport and instead contact their airline for further information. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nara Chahich. This is Bloomberg. Francine.
Thank you so much, Nair. Now, oil is rebounding from its biggest weekly decline in 2 years, but gains are still being limited by concerns over U.S. shale output. It comes as hedge funds scale back bets on rising WTI prices by the most since August. Anthony Di Paola, our Middle East energy reporter, joins us now from Dubai. Anthony, good morning. If you look at the factors driving the latest volatility in oil prices and outlooks, is it shale? I mean, last week, the kind of the rout took a lot of the commodity, or at least the oil stocks with it.
Yeah, good morning, Francine. It does seem to be shale. Shale came in pretty strong. There was a lot of length in the oil market. We're still seeing investors taking record long bets on oil prices, betting that those prices are going to go up in the future. With the kind of the volatility that we saw in the market last week, they've kind of dialed back on that a little bit. It seems that there is some nervousness that the increasing amounts of shale coming in will bring down the prices, and we're seeing some starting doubts about the strength of demand in the market as well, Francine.
Anthony, what's the view on the drop in price and rising U.S. production from the Middle East and OPEC? I mean, in good days, I keep on being told, Saudi Arabia and Russia unilaterally cleared the markets, demand is rising. On bad days, people freak out and say the shale producers are back.
Yeah, they're still pretty much putting a brave face on it here in the Middle East on the days when the price is up towards 70s that we saw last month. They're saying, well, we shouldn't take it at the price of any certain day to say that it's too high. Yesterday, we had a chance to speak with the UAE Energy Ministry. He was saying, let's not panic now that it's getting a little bit too lower. They are saying they're not too concerned yet about shale coming into the market, but it does look like this is kind of OPEC's worst nightmare starting to come true as we see that competing production from shale coming back in a strong way, as we have seen prices, for a long time now above that $50 level where a lot of people say, shale is in the money and shale will come back. If we do see some additional signs of weakening demand, or even demand that's not as high as OPEC needs it to be later in this year, that could put even more pressure on oil prices and even more pressure on OPEC to act to try to save their strategy here, Francine.
Anthony, let me just show our viewers one of my favorite oil charts, and it basically compares, oil rigs to WTI, and you can see the white line is the U.S. shales, and you can see that kind of as soon as the price of oil goes up a touch, they kind of turn on the taps. Can we say for certain that volatility is going to be back when we look at the price of oil?
It looks like it's going to be a bumpy ride again this year. Again, as I said, OPEC trying to put a brave face on things. They were saying, this year we hope it's going to be a more stable year. Last year we saw swings of about $25 from the peak to the trough. And some analysts are saying that we should expect that again this year, so to see those prices bouncing around again. I mean, if this past month is anything to judge by, we've been up close to 70 and then down close to 60 already. So we've already seen a $10 swing in the price, and we're only a month and a half into this year, Francine.
All right, thank you so much. He is Anthony Di Paola, and he's Bloomberg's energy reporter in Dubai. Now, we're just getting some breaking news out of a little bit of M&A. We understand that TDC will withdraw its recommendation of the transaction with MTG to combine MTG's Nordic entertainment and studio business. Now, this is yet another media M&A possible consolidation. You can see TDC gaining some 4.5%. So we understand now that TDC will withdraw its recommendation. It has said that it was approached by a potential bidder for all shares of TDC. So we'll, of course, talk about that and talk about Qualcomm and Fox shortly. Let's get back to oil and inflation. Still with us, Andrew Sheets from Morgan Stanley and Peter Dixon from Commerzbank. First of all, Andrew, just a very quick question on this M&A, not specifically TDC, but are we going to see a lot more M&A deals this year because of valuations and cheap money?
I think so. Look, I think you have a lot of the elements there. You have still pretty strong growth. You have still quite easy policy. Certainly for U.S. companies, they've just received a large windfall, and when our analysts take surveys of what those companies will do with it, quite a few mention M&A or some form of shareholder return. And M&A volumes, I think quite surprisingly, in both the U.S. and Europe are quite low on kind of the 10 or 15-year range. So I think we would expect them to pick up.
Are you looking at M&A and the crossover in your world, or not so much, Peter?
Well, obviously, it's something we keep an eye on because, it is, I think, a barometer of sentiment, corporate sentiment. We've seen a reasonable rack up over the course of, the last couple of years. But I increasingly get the sense that many companies are looking at M&A and thinking, well, is this something which is going to add value? Yes, the conditions are right for it to happen, in terms, certainly financial conditions. But in terms of what it does for our business, I think companies are being a lot more choosy about what they do these days.
Okay, let's get back to oil. What do you do with oil? It doesn't have that much of an impact on inflation, or does it, Peter?
Well, it does, depending on the extent of the moves. I mean, we've seen over the course of the past couple of years, it's been one of the key drivers. In terms of oil, for what it's worth, we think a price of around about 60 in the course of this year is reasonable. We're not that far from it. But as you said, the problem, as we've just heard, is that once the shale guys open the taps, that oil price could go all over the place. So it's the volatility, a bit like equities, that we have to deal with. And it's the volatility in oil prices which is going to have an impact upon inflation. So I think for that reason, central bankers, when they're looking at inflation, probably are much more interested in the core rates, which, they're edging up a little bit, but they're not going very far, very fast. As an investor, obviously, we care about oil because that drives a lot of our portfolio recommendations.
Andrew?
Yeah, look, I think the energy sector is a pretty attractive place to look here. It's underperformed significantly. You have a lot of energy stocks that are trading where they were back in June when oil was significantly lower. And it's a sector that has significantly focused on cost, probably more so than other sectors, and which we think will drive quite a bit of free cash flow, even if oil stays at current levels. So, we spent all this time talking about valuations and how the valuations on many asset classes are expensive. I think this is a sector that is not particularly expensive, and it's one that we like here, especially as it's sold off sharply in the last 2 weeks. Okay,
but do you worry that actually there's chronicle underinvestment in commodities or in oil price, and then the oil price shoots up? I know you have the kind of the factor, the shale producers as a valve, but what about the other commodities?
Yes, so I think that's a reason why we're positive on the sector. The sector has been from a structural basis cutting back on capex. You hear that even in the more recent earnings calls, where companies are really focused on shareholder return, not reinvesting in their businesses. And look, shale is a powerful force, but there are limits on it. We think there are limits on how much it can produce at really low cost levels, and ultimately that lack of big picture investment in the sector we think will drive oil prices higher. That's driving Martin Ratz, our commodity analyst, forecast for higher oil prices this year.
Peter, do you agree?
Well, to a limited extent. I mean, I think what I would say is there's a lot more capacity in the market to ramp up supply if necessary. I mean, I don't think it will be necessary this year because I think to a large extent the demand is already factored into the price. But if it were the case that for example, demand suddenly were to spike up because growth outperformed our expectations. I mean, OPEC, as we all know, has the capacity to ramp up output if it wants to. So I think from that point of view, I think that there's enough supply out there, and as a consequence, I don't think the price will necessarily spike too high as a result.
All right, thanks so much, Peter Dixon there from Commerzbank, Andrew Sheets for Morgan Stanley. Both stay with us. Up next, transition talks. South African President Jacob Zuma's fate is set to be sealed later today when the nation's ruling ANC party meets. We're live in Cape Town next. This is Bloomberg. You're watching Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the South African President Jacob Zuma's fate is set to be sealed later today when the ruling African National Congress meets to finalize the transition to a new administration. Zuma has defied growing pressure to resign since his deputy, Cyril Ramaphosa, replaced him as party leader back in December. Now, our South African economy reporter, Amo Mbatha, joins us from Cape Town. Amo, first of all, what can we actually expect from today's ANC meeting? Is it definitely more pressure on Jacob Zuma to resign, and can the ANC force him to do so?
Well, there certainly is more pressure on President Jacob Zuma to resign as the head of state. Deputy President Cyril Ramaphosa did say at a rally yesterday that was commemorating the release of the former President Nelson Mandela from prison. He clearly stated that today's meeting of the ANC's highest decision-making body, that being the National Executive Committee, will finalize what has been 2 weeks of talks between him and President Jacob Zuma on him stepping down before he's scheduled to, which would be next year when the country goes to national elections.
Amo, is there an indication that Jacob Zuma is actually willing to step down?
Well, it seems as though there's been talks over the past couple of weeks, negotiations, perhaps even setting out of terms and conditions that he'd like for him to step down before his term expires. Whether or not there'll be a stalemate in tonight's meeting is quite unclear, because it is clear that President Jacob Zuma still has a support base within the ANC. The party itself is very much divided, so we'll have to see and follow very closely as to how that meeting pans out.
Amo, I spoke to actually Cyril Ramaphosa over in Davos a couple of weeks ago, and he was very clear that he didn't really want to push Jacob Zuma out because it'd be bad for the country. Is that right? Do investors actually now want the president gone, or do they want a more orderly transition?
Well, it seems as though with the rand having strengthened after Cyril Ramaphosa was appointed and elected the new ANC president in December, it's a clear indication that investors have quite a lot of confidence in him. And perhaps even investors may have anticipated this transition much earlier. It also seems as though ANC members themselves have been saying that it's time for President Jacob Zuma to step down so that there can be a new government that's in place, a government that is spearheaded by Ramaphosa, who has clearly promised to tackle corruption and also help to attract investment into the country to hopefully change the economic trajectory, which we've seen that the economy has really been growing at the slowest pace since a recession in 2008.
Amo, thanks so much. Amo Mbatha there, our South African economy reporter in Cape Town. Now let's keep the conversation on emerging markets. Andrew Sheets from Morgan Stanley and Peter Dixon from Commerzbank are still with us. Peter, I don't know whether you delve into emerging markets or you like emerging markets, or there's you kind of look at emerging markets as a segue from a possible temper tantrum on the inflation data on Wednesday from the U.S.
You look at them and say, well, I've said for years that the economic potential that these markets offer is fantastic. If you can invest in them and you're prepared to stick it out for the long term, stay there. But in the short term, with a huge amount of volatility across the financial world, with concerns about what the Federal Reserve is going to do, with concerns about what the dollar will do, I think you have to be very wary about stepping into emerging markets at this stage. At least that's how I'm seeing it.
Andrew?
Yeah, so I think on the equity side, I think we actually see better value in some of the developed markets. I think that a market like Europe, we think offers better outright deep value, and we think that actually, EM has had a great run, but I think with the Fed tightening policy, I think with actually quite a bit of tech exposure within EM equities now, we think it's a market set up to be a little bit more challenged. We do like the local rates market in EM still. That's been one of the core views of our EM strategy team. I think from a cross-asset perspective, it looks good relative to other types of yield-generating assets, and that's still a place we like.
If you look at the Fed, does a weaker dollar actually mean that it could hike a little bit less because that's an extra layer of stimulus?
Yeah, so I think that...
hike more.
Yeah, so I think that's an important point. That's something we need to watch. I think, the good news the Fed has going for it, the good development for Powell is that the market is now at least in line with the Fed's own dots of 3 hikes this year, and that will make his job a little bit easier. But I think you're absolutely right. There's an enormous amount of stimulus coming to the U.S. economy. You have a large unfunded tax cut. You have a very weak dollar. You have a low unemployment rate. This is all new developments relative to the Fed's forecast. So these things I think need to be watched. And again, I think real yields are one good proxy to reflect how the market's thinking about that.
Peter?
Well, indeed. I mean, and the other thing that we're looking at in emerging markets these days is a significant capital outflow. And I think that, in a sense, may well be a response to the rising interest rates in the US, allied to the concerns about the dollar. So I do get a sense that investors have a certain degree of cold feet with regards to EM. That's not to say that this will necessarily continue for throughout the year. There may be good opportunities to get back in, but for the moment, at least, I think it's a tide against which you don't necessarily want to swim.
Okay, thank you both for joining us. Andrew Sheets from Morgan Stanley, Peter Dixon from Commerzbank, both stay with us. And up next, we talk a little bit more about the budget breakdown. President Trump is to seek billions of dollars in new spending for his infrastructure plan. But will his proposal gain traction in Congress? We'll have the latest on that. This is Bloomberg. Markets, economics, finance, and politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Nair Chait. Hi, Nair.
Hi, Francine. Comcast is considering making another bid for much of 21st Century Fox 2 months after Fox agreed to a deal with Disney. That's according to a person familiar with the matter. Comcast has offered $60 billion for the assets, which include the movie and TV production company, a 39% stake in Sky, and a lineup of pay TV channels such as National Geographic. That's a higher bid than Disney's $52 billion offer. Barclays says the UK Serious Fraud Office has brought charges against its Barclays Bank operating unit in a case linked to a 2008 fundraising. The SFO says the charges relate to financial assistance Barclays Bank gave to Qatar Holding in the form of a $3 billion loan for the purpose of directly or indirectly acquiring shares in Barclays. Both the main company and Barclays Bank intend to defend themselves against the charges. Heineken says profitability this year will fall below its medium-term target as it integrates a Brazilian business it bought from Japanese rival Kirin. The world's second biggest brewer says its operating profit margin will expand about 25 basis points this year as sales gain. Volume growth was led by Asia-Pacific, where Vietnam is one of Heineken's biggest markets. Airbus and Emirates have signed a contract for an additional 20 new A380s with an option for 16 more. But elsewhere, the plane maker's most important aircraft is still suffering teething troubles. Some deliveries of the A320neo jet have been suspended following another issue with the engines supplied by Pratt & Whitney. Airbus says 30% of the planes in question have faulty engines. And that's the Bloomberg Business Flash. Francine.
Thank you so much, Nara. Now let's talk the U.S. President Trump campaigned on $1 trillion fix for crumbling roads, bridges, and airports. But the plan he's rolling out today commits the federal government to spending just a fraction of that amount at $200 billion. Well, Trump's proposal comes on the heels of the $1.5 trillion tax cut, as well as a $300 billion spending measure that will add to the budget deficit, making some fiscal conservatives in Congress squirm. So this will compete with lawmakers' attention with the battle royale over immigration and other issues. So how much attention should investors be paying to Trump's infrastructure plan, and how bullish should they be on the U.S. economy? Andrew Sheets from Morgan Stanley and Peter Dixon from Commerzbank are still with me. Peter, first of all, what's the real danger of the U.S. economy overheating?
In my view, quite limited. Obviously we're running with relatively little spare capacity now compared to where we were a year or two ago. But the economy's trundling along. It's not exactly, going through the ceiling as it maybe was 20 years ago when we talked about overheating in the context of the dot-com bubble. The economy is growing at rates slightly above trend. I think the danger of overheating there is relatively limited. In any case, even if we were to see a pickup in inflation, which would be the obvious signal of an overheating economy, it's time for the Fed to step in. They've said they will. The Fed's on that particular ball.
Do you worry about overheating?
I do. I mean, I think that's a very fair point. I don't think the risks relative to are like they were in 2000, but I think you do have. You have unfurled basically, I think, every sail you would want to boost an economy that was otherwise strong. You have a large tax proposal. You have very low interest rates. You have a very weak dollar. And you also are now proposing an infrastructure plan. And I think that the big story here is maybe not necessarily what it does to the economy now, but when the next recession comes, and the next recession will come, what is there left in the toolkit to offset that? And, you've already done a tax cut. You potentially have already done the infrastructure. The Fed might be under greater pressure to not expand its balance sheet in the same way. And I think that's a real challenge.
Right. But is it time for the Fed actually to scale it back? As Peter was saying, like they've telegraphed it enough times and the markets maybe need it.
Yeah, well, and I think that's going to be going on in the background. So at the same time that the U.S. government is going to be spending more money and borrowing a record amount of money, or close to a record amount of money, the Fed is going to be reducing its balance sheet and buying fewer securities. And I think this is the tug of war that you're seeing play out in the rates market. I think this is behind some of the curve steepening we saw over the last week. And I think this is directly behind some of this rise in real interest rates in the U.S. is this big supply and demand shift that you're seeing between the Fed and the federal government.
All right, Andrew and Peter, thank you so much for joining us today. Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley, and Peter Dixon, Global Financial Economist at Commerzbank. Now, Bloomberg Surveillance, as always, continues in the next hour with Tom Keene, who joins me out of New York. We'll be speaking exclusively to the Italo chairman, Luca Cordero di Montezemolo. That's after the high-speed train operator accepted a takeover bid. We'll also be joined by the Maltese finance minister. We'll be talking Euro and ECB. This is Bloomberg. Market bounce, global equities rise, oil rebounds, and U.S. futures point higher as a new trading week begins. Is Wednesday's U.S. inflation report the next big hurdle? Policy shift. The Trump administration says it's willing to engage in nuclear talks with North Korea. On the domestic front, the president unveils his long-awaited infrastructure proposal. And just 3 weeks before Italy heads to the polls, we speak with the former chairman of Ferrari on the business climate in Europe's fourth largest economy. Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua in London. Tom Keen's in New York. Tom, we talk inflation, but actually quite a lot of anticipation on what kind of market week we'll get as well.
Well, the market week as well. What a needed weekend after what we saw last week and really back to a week ago. Friday, certainly yields higher is the number one story this morning, Francine.
Yeah, yields higher, and that has all sorts of implications. We're talking about on Friday, Tom. It just depends on whether this gets, this kind of, route continues and whether it infects other asset markets, and that's what we're looking at for this week. Now let's get straight to the Bloomberg First Word News. Here's Taylor Riggs. Hi, Taylor.
Francine, Tom, President Trump's budget director warns that interest rates may spike because the U.S. will post a higher deficit this year. Still, Mick Mulvaney says that lower deficits are possible over time because of sustained growth from tax cuts. He called deficits a very dangerous idea, but, quote, it's the world we live in. President Trump will ask for billions in new spending to build a border wall and fight opioid abuse. The White House comes out with its budget proposal today, but it's likely to get little traction in a Republican Congress that has its own spending priorities. Germany's Chancellor Angela Merkel is defying critics in her own party. She says she's determined to serve another full term. Merkel is facing a backlash against last week's coalition agreement. Some say she sold out to the Social Democrats in order to extend her 12 years in office. And London City Airport has been closed after the discovery of an unexploded World War II bomb. The bomb was found in the River Thames during development work at the airport. Carriers, including British Airways and CityJet, were forced to cancel flights. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Francine, Tom.
Taylor, thanks so much. Equities, bonds, currencies, commodities. Let's give you the market adjustment. Where are we right now after the weekend? The answer is pretty darn good. Futures up 31. Dow futures up almost 300 points. 2-10 spread comes in, fractionally. Euro doesn't do much. And oil churning here near a 59 print on American oil. Next screen, please. Tania with the VIX coming in nicely. Recovery lows, 26.22 and almost 3 big figures on VIX. Really, the Dow at 24,000 close on Friday shows how remarkably resilient equities have been, everything considered. We are away from the correction level. Maybe that's the number one number. I'm using 3%. Sort of is a benchmark for 30-year bond, Francine, and we're now 18 basis points away from that 3.00. You even begin to wonder about a 3% 10-year yield, although we're nowhere near that.
Yeah, although I think Gundlach had a call on that. I mean, there was always the kind of Bill Gross call with Jeffrey Gundlach that we need to maybe revisit, Tom. This is what I'm looking at. Overall, investors seems to be getting a reprieve. So that's not the Forex report. It's kind of my data check, but it is a little bit of foreign exchange in there. Euro dollar 122.62. Investors seeing a reprieve from the Radon stocks, the worst volatility spike in 2015. If you look at equities, they're rising in Europe. Treasury's falling, as you're saying. But I'm also looking at dollar. So the dollar is falling, and then if you look at oil, it's just above 60, but just barely above 60, Tom.
Let's look at the great bull market, Francine, but this not in equities. Let's look at the bond bull market. This is a great series, the Bloomberg Barclays U.S. Total Return Series. So this brings your cash flow into the index as well. Here's the Lehman low over here. And in bonds, up we go. This is logged, this nice steep move here, another steep move in 2012. Little bond pullback 1, little bond pullback 2, and then here's the third pullback, and this is all we've seen now. Francine, the message here, which is going to be across surveillance this morning, is full faith in credit is 7% down from the top, where an aggregated bond portfolio is only 2 or 3% down. So bond price is actually doing a little better than the gloom of the 10-year or the 30-year piece.
Yeah, I really like your chart, Tom. This is my chart. It's not actually that dissimilar to yours, but it's looking at the S&P 500, and a lot of traders are still figuring out exactly what happened last week, if they could have foreseen it, if they will foresee it in the future. And if you look at the S&P, so every time there's been a correction, and that goes until 2016, and then you can see that kind of 18-month period where things have definitely been almost too cool, right? You talk about pent-up, no volatility, but you could also argue pent-up, no downward movement of 5%. And then you see that correction that was quite significant last week. So it's a good way as we go on to this week, Tom.
Well, with all my coughing, I want to show this for our global audience. This is what's going on in America. For those of you on Radio London, the New York Post, get your kid a flu shot now. And we have tragically had 4 children die in the city from the flu. And everybody, the cough I have, everybody's got it. I mean, you've got it in different ways, in different forms. But I just wanted to show that to a global audience. I don't know what London's like, Francine, but this year is different in America.
Yeah, they talk about the Australian flu. I mean, there's, everyone has a flu bug, but who pays for the vaccine shot? And for me, that's actually quite significant. In London, a lot of NHS actually, they give flu shots for free and people above 65 and up to 8 years old. But this is a huge cost to the national insurance system. Yeah.
Above 65?
There you go.
Wow.
All right. Imagine that. Let's get back to the market. U.S. futures pointing higher with European and Asian equities recovering from the worst weekly rout since 2011. Japanese markets are shut today due to a holiday. 10-year Treasury yields continuing to climb, touching a fresh 4-year high amid concern that the Fed may accelerate its rate hiking schedule. Investors awaiting U.S. consumer price data on Wednesday. So there's quite a lot going on. Joining us now with his perspective on the market whiplash is Eric Nielsen, and he's UniCredit Group Chief Economist. Eric, thank you so much for joining us. As always, you do make us smarter on Fed policy. So when you look at the volatility that we had last week, first of all, what's the chance that to kind of away from, the VIX index, away from equities, this starts infecting the credit markets?
It is always a risk, and it will to some extent. But the credit market is sort of, as Tom said, it's a bit of sort of the stable cousin of the equity market. So I think a little bit of concern there, but not too much, really.
Okay, what does it mean for Fed policy? Does the Fed look at the market from last week and think we need to keep a closer eye on it? It was actually quite amazing to see that volatility started on the day that Jay Powell took over.
Yeah, I mean, bad luck for him in a sense. I think Bill Dudley and Bullard have already given us the answer to this. At least as on present data, they said the path is already in place. We are not hesitant. Bullard said this is just a minor correction. Bill Dudley, I think, called it small potatoes. So he's sort of saying there's no real issue here. I thought last week we got a little bit of a disconnect between what the Fed told us, which is normalization is still going on, and the market started to price down the short end of the curve, suggesting that they may worry a little bit of a slowdown in the market. Now, today is changing again, of course. But, central banks are not and should not be worried about weekly moves in markets. So I think for now, at least, if this is a technical thing, as we think and hope it is, then I think the Fed is on track for their 3 hikes.
Eric, one of the great ideas here from people like you and great optimists like you, as you've been on Europe, is the idea that yields moving up is a good thing. Bring up the chart, if you would, Anthony. This we've shown many times. This is the 30-year bond. Most bond portfolios are not out at 30 years. They're in at 7 years or 5 years. But we're down 7% now in price on the 30-year bond from that moving average study. Explain to me why this is a good thing. I believe I have a loss in my 30-year bond.
It's not a good thing at all. But I think your point is exactly right, that it is. We are in a stage, in my opinion, where normalization is underway. Whether this is a market turmoil a little bit on the way and how deep it is, I don't know. But we are fundamentally at a crossroad where yields are moving higher because the economy has done well. And there's been a lot of confusion about whether inflation was nowhere to be found or would never come back. Our view has been that it was delayed, but the Phillips curve fundamentally still works. And therefore, we think that with the tight labor market and now with the fiscal stimulus in America, you will get more inflation, you will get higher wages, and therefore you will get a higher yield, higher yields in the long end.
Are we going to get higher inflation-adjusted yields, higher real yields?
Yeah, slowly, right? I mean, and you should. I mean, the game of the Fed would be in a normal, unless something strange is going on. What the Fed is trying to do is to inject a bit of cooling, as I think one of the previous Fed governors said, that you remove the punch bowl a bit. So you're trying to take a little bit, and that means you have to bring a little bit higher real yields into the game. And with inflation picking up, they may, as we have been talking about on this show for quite some time, they may in many ways be a bit behind the curve. If they are, and it sort of picks up, then it could be a bit more volatile.
Okay, how sharp would the correction be?
In
what you're talking
in yields.
about there, yeah, in yields.
Well, I think you could easily get through 3% on the 10-year. I mean, it depends again if the stock market can't take it, right? Then it will take a bit longer. But they need to get over 3 at one stage. I mean, there's no way that it stays down here.
All right, very quickly, what about bonds? If you see a sharp repricing in treasuries, could you also see a sharp repricing in bonds? And this is something that the market for the moment is completely ignoring.
Yeah, I mean, not as sharp because the correlation is not perfect anymore. And it is in America that you have expanded the budget deficit tremendously so, and you are already in the process there of reducing the balance sheet of the Fed. So it would be far from one-to-one.
All right, Eric, thank you so much. Eric Nielsen there of UniCredit is staying with us. Coming up in the next hour, we speak with Kathleen Fisher, A.B. Bernstein, head of Wealth and Investment Strategies. We'll talk to her about the market reaction and also credit. This is Bloomberg.
This is Bloomberg Surveillance. I'm Taylor Riggs. Let's get the Bloomberg Business Flash. Breaking just in the last few minutes, Blackstone Group has held initial discussions about bidding for Onbing assets in a sale overseen by the Chinese government. This is according to people with knowledge of the matter. The assets include the Waldorf as well as strategic hotels and resorts, which Blackstone sold to Onbing back in 2016, these people said. In the UK, Barclays operating unit faces a new criminal charge over its controversial capital fundraising at the height of the financial crisis. The Serious Fraud Office accuses Barclays of unlawful financial assistance. It has to do with the $3 billion loan the bank got from Qatar back in 2008. 4 former executives and the bank's holding company had already been charged. Barclays says it will defend itself. A private equity firm and a Dutch pension fund are making a joint bid for AkzoNobel's specialty chemicals unit. That's according to the Financial Times. The FT says the pension fund, PGGM, would be a minority co-investor alongside Apollo Global Management. The Akzo unit could be valued at more than $12 billion. And a new deal will ensure that Airbus keeps producing its A380 Super Jumbo for at least the next decade. Emirates has signed a contract for another 20 of the double-decker planes. The deal has a list value of $16 billion. Last month, Airbus said the A380 program could be terminated if there wasn't a new sale soon. And that's your Bloomberg Business Flash. Tom, Francine.
Taylor, thanks so much. Within the zeitgeist over the weekend, with all the distractions of the White House, there really was no other topic in American economics. And that is the budget deficit and the planned deficits and the voted on deficits of the United States of America. It's good to get a view from a distance across the Atlantic with Francine Lacroix, Eric Nielsen of UniCredit Group. I know your Harbandos will write upon this, Eric. I would love your thoughts on the chronic nature of deficits. Is America becoming like Europe in that we're getting chronic in our fiscal irresponsibility?
No, far from it. You passed us a long time ago, Tom. I mean, think about this. The American economy is basically at the height of its cycle. It's full employment, more or less, as we think it is. At least you have had a the second or third longest recovery. And bang, here comes the deficit, already about 2.5% of GDP, bounded to about 5% of GDP. I mean, in Europe, we don't even do this in a recession. So no, this is a highly unusual policy from an economics point of view.
Dr. Nielsen talks there, folks, about the deficit as compared to nominal GDP. Let's look at a chart of just flat out the deficit, or even for a brief moment, the surplus here. Here's World War II over here. This is just the nominal amount of debt. And it's not logged. There's no fancy math involved here. The trend's like this. And we're looking at 1, 2, and even 3 years down here at $1,000 billion. And I go, Eric, again to the destabilization of this. What does this signal for America?
Well, I think it signals. I mean, first of all, it signals that policymaking is unusual, to put it very politely. More importantly, it tells you, as we talked about before, yields have to move higher. I mean, you have a lot to finance for a long time to come, and it will probably, or it almost certainly will stay with us when the economy starts to slow down, as these things do occasionally. So this is quite troublesome, I think it's fair to say, and it's not good for the overall economy if you look sort of 2, 3, 4 years out.
How difficult can it get, Eric?
Well, it can get very difficult, but then if you get a downturn, you kind of do QE or something else, and you stop the balance sheet reduction. And I mean, think about Japan. It's sort of, you go on for a long time. It is, so long as you have trust in the system and people trust the money, then you can actually get away with almost murder, but you can't walk on water, right?
Okay, but I mean, we're also seeing, and again, this could be related or unrelated, you know, the Chinese may be buying less treasuries, and this is, we're hearing possibly because of trade concerns, or possibly it's just a diversification of their holdings. But again, how much can the U.S. actually afford this?
No, I mean, they can't afford it forever, and this comes to the trust. I didn't mean just in terms of trust in the government and the dollar, but also in the dollar as the reserve currency. And the Chinese, as you said, I mean, at one stage you're saying I can get better returns somewhere else, maybe political returns by buying things in the developing world or mines or what have you, or invest it domestically, right? It's
Eric, here's a great MMR. We're going to show this in both hours, folks. A lot of reading over the weekend on this. Paul Krugman writing a more technical piece, a lot of think tank pieces. Well, here is the great Robert Samuelson. Why should we worry about escalating debt? The answer in a word, prudence. We don't know how much federal debt is too much. Once investors, traders, and speculators and Eric Nielsen lose confidence in a country's debt, the economic, social, and political consequences can be devastating. The prudent thing to do is never get close to the line. We aren't being prudent. This is quadratic, Eric Nielsen. Are we anywhere near a quadratic move where we get yields back on a real basis to where they were in the JFK and LBJ 60s?
I think that's a long way away, Tom. I mean, it is, but the direction is coming, right? It depends. In real terms, they're still very, very low. So for me, it's to start with, it's a question of normalization, and on top of that comes this, frankly, irresponsibility of American fiscal policy at this stage. So I think you're on your way to what's that line Samuelson sort of talks about, but I think it's still a good long way out.
Yeah, this is going to be fascinating. Eric Nielsen with us, and this is a theme, no doubt, we're going to touch upon right up to the midterm elections. It really brings me back to the idea of deficit scolds, something Paul Krugman's talked about, where when there was weak GDP, the deficit scolds perhaps got it wrong. Nobody's talking about deficit scolds right now. Coming up on Bloomberg Markets, a conversation with Jim Messina, former Deputy White House Chief of Staff. That is timely, to say the least. This is Bloomberg.
Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, let's talk about emerging markets and investors taking it on the chin last week, and they will be vigilant about what comes next as volatility roars back to life. In his latest note, our guest host points to that local currency EM fund saw a big inflow during the first week of the turmoil, suggesting good support for this asset class. Let's get back to Eric Nielsen of UniCredit. Eric, what do you do with emerging markets right now?
You buy the local currency. I mean, I think you want to scale back, as we've seen people do in the hard currency debt. But I think you want to still buy equities and you buy the local debt. You stay away from maybe the 4 or 5 most fragile countries, those with the big deficits and a bit of more messy policies. But it's a very big and diverse asset class, so one should be a little bit careful with these type of generalizations. But generally speaking, the world looks very good outside the United States in economic terms.
But is it economic terms, or if you look at some of the equity performance for a lot of emerging markets, it's actually led by chip makers, right? By the things then used in artificial intelligence.
Yeah, and that's not going to go away. I mean, I think it's so I wouldn't be. I'm not a single stock picker, but I wouldn't be worried about that sector, because this is a booming area which would drive the economy for a long time. So, and whether that's happening in Berlin or in Silicon Valley, it doesn't really bother me a whole lot.
Okay, thank you so much, Eric Nielsen there of UniCredit. Eric stays with us. Coming up next, while we speak about elections, we also talk with Luca Cordero di Montezemolo. He's the Italo chairman, former chairman of Ferrari. We'll ask him about IPOs and actually buyouts. So that's the one that I'm looking forward to. And then a little bit later on, we also talk ECB and Euro strength with the finance minister of Malta. In the meantime, this is your data check. As Tom was saying, a lot of the concerns onto the markets, maybe spreading to the credit market. Nothing's happening yet, but that's definitely the big one that investors are looking out for. Markets in general seem to have a little bit of a reprieve from the rout in stocks. We did see last week the worst volatility spike in 2017. The dollar falling, Treasuries falling as well. There's a little bit of concern out there that President Trump's budget proposal will drop his party's goal to balance the budget in 10 years. We'll discuss that next. This is Bloomberg.
Good morning, everyone. Bloomberg Surveillance. Francine Lacqua in London. I'm Tom Keene in New York. In the markets, the VIX actually stable, actually a much more attractive number. I'm going to go over here and look at futures up 28 right now. On this Monday, your first word news briefing for the morning. Here's Taylor Riggs.
Tom, Francine, the Trump administration is signaling a policy change on North Korea. Vice President Mike Pence says the U.S. is ready to engage in talks on Kim Jong-un's nuclear weapons program. According to the Washington Post, Pence and South Korea's President Moon Jae-in agreed to pursue dialogue with the North during talks at the Winter Olympics. Pence says the U.S. will keep putting pressure on North Korea. President Trump may struggle with that promise to spend $1 trillion to fix the country's crumbling infrastructure. The plan he rolls out today commits the federal government to spend only about $200 billion. That funding would be used to spur local governments and the private sector to come up with the rest of the money. Democrats call that bait and switch. In Russia, investigators are trying to figure out why a passenger jet crashed not long after taking off from Moscow. All 71 people on board were killed. The plane belonged to regional carrier Saratov Airlines and was on a flight to the city of Orsk. And British Prime Minister Theresa May is starting a drive this week to end the Conservative Party's civil war over Brexit. Senior UK ministers will deliver a series of speeches setting out a vision of life outside the European Union. Conservatives are split between those who want to retain close ties to the EU and hardliners who want a clean break. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Tom, Francine.
Taylor, thank you so much. Now, located 80 kilometers south of Italy in the middle of the Mediterranean Sea is the smallest and southernmost EU member state, and that's Malta. As UK and EU officials work through the second round of Brexit talks, while Malta's finance minister has been quoted as saying the UK will blink first. On the economic front, the European Commission has raised the country's growth forecast for the next 2 years. Well, joining us now is Edward Scicluna. He is the finance minister of Malta. Still with us also Eric Nielsen, who's chief economist at UniCredit. So, Minister, thank you so much for joining us right here on Bloomberg Surveillance. We have a lot to talk about, the Euro, ECB policy overall. Were you worried about Brexit?
Well, we always thought it was going to be a saga, with ups and downs, and also that there would be more uncertainty on the UK side than the EU side. We thought that the EU will have a problem because there are 27 countries and to agreeing on a position, but that didn't materialize. In fact, what's strange now is that on the UK, there's some dissonance or disagreement from one country, which doesn't help at all.
But Minister, when you look at, I don't know whether you worry about, a race to the bottom. We were just talking with Eric Nielsen about the Italian elections, promises of a flat tax cut rate. I guess if Brexit happens, certain economies may be juggling for a position. Where does it actually leave Malta?
No, Malta is in a position of strength in the sense of doing well both on the economy side, that's been growing over the last few years, and now it's, in order to continue on its growth, it's relying on inputs from the EU itself. In other words, inflow of the labour force, with which we can't grow at 6% or higher. And also on the public finance, which we, through some reforms, we've managed to cut the deficit and now turn it into a surplus. So that helps. But on the other hand, we're more observant, that we're more pragmatic. In a way, we're like the Germans in the sense we don't go for big visions, which we can't deliver. We're quite pragmatic. Our position on Greece and other issues is like that. We're concerned with moral hazard, for example, the fact that countries have to be on a level playing field before they start talking about risk sharing.
Minister, Malta has gotten a lot of bad press lately, also because of the death of the famous journalist that was looking into affairs of the government. What's your response? Do investors ask you about that? Are they concerned about the rule of law in Malta? And how can you reassure them if you can?
No, Malta has had a very good record in terms of regulation and its framework. So when you get bad news, or you'd say, is this the Malta I know? And that's the kind of reactions we get. But we need to address them, and that's what we're doing. For example, on governance issue, we're just saying it's not on the press. They have every right to say what they like. And obviously there is an infighting there between two strong parties in Malta, which really opened up and made certain, tabloid sort of statements being made. Although I must say there were some developments, unfortunately, which didn't help. But we're addressing, we've got internal evaluation on anti-money laundering being done. We've got a plan. We did the risk assessment, so for all to see. It will be announced soon. And especially any weaknesses, especially of coordination between, say, the police, the FIU, and also the MFSA and the central bank. All together, they need to get the action. We're setting up a national coordinating committee now to start working seriously. So we want to, correct any bad impression. Of course, if it spills over into a question of taxation, that's another issue. We always wanted to distinguish between competitiveness and also between tax avoidance and tax evasion, which we don't condone. So we've cooperated with the ECOFIN. We didn't veto anything, where we've passed through important directives. Now it's a question of implementing them in the year and a half to come.
Minister, wonderful to speak to you today. To most Americans, Malta is something out of an Aubrey and Maturin novel of Patrick O'Brien, with the drinking of a good bottle of port off the deck before the next Napoleonic War extravaganza. That's got nothing to do with the reality. What do you need from Europe, and what do you need from Germany to keep Malta, Malta? Your major issue is foreigners want to move to Malta. How are you going to keep Malta, Malta?
Well, Malta is a question of exploiting its strategic location. And it's not a question of war or anything of the sort. That's history. It's close to the North Africa and the Middle East. It's the most southern European country where English language is an official language. And therefore, for business, it's quite important. That's why its attractiveness. Also, it has its own mother tongue, which is Semitic. And that brings sort of Jordanian investment and other investment. They feel quite at home in Malta. Although it's Christian and European, at the same time, it has got a Semitic language, which, people from North Africa and the Arab world are, they feel they're at home.
Minister, talk to me about, there's a Euro area finance minister vote on February 19th about who will be the vice president of the ECB. Two candidates, Spain and Ireland. Who will you vote for?
Well, that's the European politics of it. Votes deserve that post, but however, the EPP, and Luis Guindos was from the EPP, worked very hard for the socialists to keep that place. Yep. And for our group, which is the Labour Party, and in that group, he did quite a good job. So it's probably the socialists would look kindly to his nomination, and probably Luis Guindos will get it.
So you'd favoured De Guindos. All right, fabulous. Well, thank you so much, Minister. I hope you come back very soon. That was Edward Cicluna, the Finance Minister of Malta, joining us today. Tom.
Francine, thank you so much. Let me look at the data right now, and certainly it is an up, better tone to the equity markets we've seen in the last few days. We're going to have to trot out a chart of the Dow or the SPX, like where are we given a recovery mode? Futures up 30, Dow futures up 290 points. Yields are higher this morning. Let's wander over to Yield True bonus Monday round. Two data screens, 26.34, 2.7 big figures in on the VIX as well. 30-year bond, that should be green, up 2 basis points. This is Bloomberg.
This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keen's in New York. Tom, to Rome and to Italy, the Italian high-speed train operator Italo expected a sweetened takeover bid from U.S. investment fund Global Infrastructure Partners last week. Now, the near €2 billion deal takes the place of a planned IPO. Italo serves more than a dozen Italian cities, including Rome, Milan, and Verona, and last year carried more than 13 million passengers. Yeah. But if you're an Italian going through the elections, you kind of wonder whether there's there's too much volatility on the markets there today?
And really, towards the election, it is industrial north versus a different south and even the middle part of the country as well. What I've noticed, Francine, just in the last week or even number of days, Mr. Berlusconi with a little more visibility. Is Mr. Berlusconi attached to old line industrial northern Italy?
Well, his coalition could be, Tom. So if I'm 100% honest, there's like a million factions talking about a million coalitions. So first of all, there are three parties that would then be kind of, overseen by Silvio Berlusconi. Now, he still has a ban because of cases in the past, so he can't actually be in politics, but what Silvio Berlusconi could end up with is being the puppeteer, and he's doing a rather bizarre coalition, Tom, with Lega Nord, who could also be qualified as much more right-wing than the Front National of Marine Le Pen. So let's get back to Eric Nielsen of UniCredit. He knows a thing or two about Italian politics, but also delves into the economy of Italy. If we focus on the election a second, without saying what's right or wrong, if there is a kind of a flat tax, which we're hearing noise of I think I've heard 22% or even 13%, how do they fund it?
That's not clear. So it's a proposal of Berlusconi's group to do a simple flat tax, and that has a lot of appeal for a lot of people. So I think it is, to a large extent, a political promise, which they will find very difficult to implement in the short term, at least. It is incredibly difficult to calculate what flat tax you need in order to get, for example, a neutral fiscal revenue number. But even if you got that number, you will go through a couple of years of losing some revenues because of the change and the confusion. So I would be a little bit worried about it in the short term if they were to go down that line. But it is only one party of many who have proposed it.
You need a little G to take care of all that debt, Eric Nielsen. You are the great little G optimist of Europe. Does Italy have enough growth rate to really put away the fiscal pain and the fiscal realities?
Yeah. It's the question we get most from investors, Tom. But here's the bottom line: if you need 1%, if you have the present fiscal stance in Italy, and you have just 1% annual growth on average over the long run, you can have interest rates move up by several percentage points without debt to GDP starting to increase. And because the average maturity of the Italian debt is the same as the Eurozone average now, or almost 7 years, it would take many years, even at a rapid increase in yields, before the average yield of the whole maturity structure moves up to an extent. And that's not just us saying this. The Peters Institute in Washington has calculated it. Olivier Blanchard had a good paper along with Settelmeier, the former chief economist at the German Economy Ministry, about last summer, that showed that in any normal calculation, this is really not an issue, but it is what people want to talk about.
Okay, thank you so much, Eric Nielsen of UniCredit. Stays with us. We'll talk a little bit more about Italian politics. Now, coming up on Bloomberg Markets, we also speak with Alan Cairn. He's the UK Secretary of State for Wales. So that's a conversation about Brexit, but also maybe pound. Look for that interview. That's at 4:30 p.m. in London. And this is Bloomberg.
This is Bloomberg Surveillance. I'm Taylor Riggs. Let's get the Bloomberg Business Flash. Comcast may make another bid for much of 21st Century Fox 2 months after Fox agreed to a deal with Disney. According to a person familiar with the matter, Comcast originally offered $60 billion, which was higher than Disney's successful bid. Disney agreed to buy Fox's movie and TV production house, a lineup of paid TV channels, and a 39% stake in Sky. 4 years ago, Blackstone Group sold New York's Waldorf Astoria Hotel to China's Anbang Insurance for a record price. Now the firm may get the chance to own the landmark again. According to a person familiar with the matter, Blackstone has had talks about bidding for the Waldorf and other Anbang assets. The sale is being overseen by China's government. And oil prices are rising today after their worst week in 2 years. That's good news for Siemens. The engineering giant says a number of projects were delayed when oil prices collapsed. Bloomberg spoke to Siemens CEO Joe Kaeser.
Now with the oil price being, let's say, 60, 70 and a very disciplined very disciplined management of, let's say, OPEC and associated oil countries. I believe that this will re-accelerate the projects going forward.
And that's your Bloomberg Business Flash. Francine, Tom.
Taylor, thanks so much. For all you worldwide, torrential and permanent rains in New York over the last few days, all of it leading to, well, a breath of spring, a dose of spring weather. That would be a spring like last year where everybody looked for strong dollar. We all got that wrong. Weak dollar ensued. But maybe right now it's about the certitude of the ECB. Eric Nielsen with us with UniCredit as we look at Mr. Draghi's central bank. I would suggest, Eric, expect the ECB unexpected. It's just too pat right now, the analysis of what the ECB is going to do. What's the unexpected for Mr. Draghi?
I think the unexpected would be a sharp and sudden end to the QE program in September. There have been. It was pretty clear from the conversation originally that they were going to go to September, then they would sort of phase it out. But the good numbers and some of the noise, and including the December minutes, suggest that maybe they will be harsher and end it a bit faster. But given the environment and the sort of the silliness, if you will, I still think that would be a surprise.
In the U.S., there's the idea that maybe growth will ebb away from the optimism a lot of people feel right now. I don't want to be gloomy about it, but just ebb away. Is European growth, does it have a resilience and integrity to it, or is there the same worry about, 10th here and 10th there, and pretty soon it's not as buoyant as you would have expected?
No, it's a lot more robust in Europe, Tom. It's okay. First of all, remember in America you have savings ratios in the private sector, which does 70% of the U.S. GDP. Savings ratios of just 2.5%, and they have been coming down as they fuel and finance de facto the reduction in it, finance the private consumption. In Europe, we have pretty steady savings ratios, about 11-12%. And we have the consumption being financed by an increase in real income. So the household sector is a lot healthier, and the corporate sector in Europe did not take all the debt you saw in America over the last, say, 4 years or thereabout. So the corporates are not as vulnerable to higher yields as in America. So we are in pretty good shape in Europe right now.
What worries you about Europe? There must be something.
Politics, I mean, for sure.
But politics enough to actually derail the Europe project?
No, I think it is not in the short term, but but we talked about a little bit. I mean, we still don't have the coalition agreement in Germany. We still we have to see what happens in Italy, and then in the medium term, I worry about who comes next, because the political fabric is changing very significantly now to a pro-European stance, and we can celebrate, us pro-European can celebrate this. But if the opposition becomes quite hostile, then we know over history that there's a risk that they gain power. So in the medium term, politics is still the worry. But again, there America runs well ahead of Europe in craziness.
I mean, do you worry about Germany? So a lot of the kind of the fact that they can't really get a coalition together, a strong coalition, is overshadowed by the fact that you have an amazing economy.
Yeah.
What happens if there's a downturn in the economy and no real political stability?
I think I'm not worried about Germany, really. I mean, as you said, the economy goes very, very well. We saw the IG Metall deal with like 3.9% wage increases, including the bonuses for this year, and over 3% next year. So Germany is moving very nicely along this cycle. And the other side of it is that if you take AfD, the Alternative for Deutschland, out, and then all other parties, voters, have 50% or more, usually 2/3, in favor of closer European integration. So there is not a question in Europe about being pro-European and integrate Europe. There is a question of how the BRICS fall, or in the next election, in a sense, and how you live with this more fragmented Bundestag.
Is there a correlation between how tough Europe is on Brexit and how integrated Europe can get?
No, I don't think so. I mean, I think what I have sensed, I was in Berlin just a few days ago, what I sense in Berlin now is a little bit more concern than before that we end up with a hard Brexit because of the Brits, but they don't want it, right? The Germans don't want to penalize anybody, and they don't want a weak Britain on the outskirts because they understand that strong neighbors are good for you. I mean, economically strong neighbors are good for you. It's this idea of punishing somebody is just not what they talk about in Berlin. Yeah. But the other side of it is Brexit is not high on the agenda. Look at the coalition agreement. This is all about France and European integration, and Brexit is this backside show.
That's right where I wanted to go, Eric, because Mr. Macron been successful in really the historic showing of the French flag worldwide, taking the first 2 days of Davos, no question about that. He was the talk of the first 2 days of Davos. Has he really developed a new economic, political France, or is it just sort of a moment for a young guy?
I think it's too early to tell, but I think there's a very good chance that he has indeed turned France into a new type of country that could last easily for several decades. These things go over long periods of time. The French decided ultimately that they wanted a more liberal economy, more Anglo-Saxon in many ways, which is what he promised, liberalization of labor markets and pension reforms. He has done part of the labor market reform, so he has done quite a lot. But then, as I say in Berlin, he has more time on his hand because he's the president. He doesn't run the government. So he's doing a very good job on the PR side.
Okay, Eric Nielsen, thank you so much with UniCredit. A good morning brief here on a Monday. Coming up on the markets, on your need to participate in the markets, Kathleen Fisher, A.B. Bernstein. This is Bloomberg. This morning, amid calmer markets, yields they grind ever higher. A higher 30-year yield, 7 of the last 8 trading days. The VIX indicates less fear. It is at recovery lows. In this hour, on the new bear market, the bond bear market to come. From sea to shining sea, finally, Washington considers your local pothole, your rusted bridge. We consider Trump infrastructure. And get over it, oil, it is unchanged from 12 years ago. We consider oil at $59 the barrel. Good morning, everyone. This is Bloomberg Surveillance, live from your VIX-infested world headquarters in New York. I'm Tom Keene at our VIX-infested London headquarters. Francine Lacroix as well. Francine, what a relief. We're not like totally VIX-centric this morning, are we?
Yeah, we're not, but we could be in a couple of hours. No, I'm kidding, Tom. But look, you're looking at a couple of market stresses, and they were unexpected last week. So just watch out for that this week. Watch out for the credit space. If anything ugly happens, it may infect that asset class. So overall, I'm looking at stocks. Look, they're bouncing back, dollar falling. It seems to be like a quiet turn to the market on this Monday morning.
A relative quiet, to say the least. Right now, with your relatively good first word news on a Monday, here's Taylor Riggs.
Tom, Francine, President Trump's budget director warns that interest rates may spike because the U.S. will post a higher deficit this year. Still, Mick Mulvaney says that lower deficits are possible over time because of sustained growth from tax cuts. He called deficits a very dangerous idea, but, quote, it's the world we live in. President Trump will ask for billions in new spending to build a border wall and fight opioid abuse. The White House comes out with its budget proposal today, but it's likely to get little traction in a Republican Congress that has its own spending priorities. Germany's Chancellor Angela Merkel is defying critics in her own party. She says she's determined to serve another full term. Merkel is facing a backlash against last week's coalition agreement. Some say she sold out to the Social Democrats in order to extend her 12 years in office. And London City Airport has been closed after the discovery of an unexploded World War II bomb. The bomb was found in the River Thames during development work at the airport. Carriers, including British Airways and CityJet, were forced to cancel flights. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Francine, Tom.
Taylor, thanks so much. How about a data check? Equities, bonds, currencies, commodities. I want to get through this quick to get to our Bloombergs and our two esteemed guests. Futures pop up 30. Dow futures up 288. 210 spread comes in a little bit. Next screen, Tania, if you would. The VIX from a 31 down to 26.38. Not three big figures, but we're getting there. The Dow, we forget where we ended up on Friday. I'm sorry, folks, not bad. And the lead story of the day, 3.18% in the 30-year bond. It's up 2 basis points. That should be green on the screen there. Up 2 basis points. Higher yield this morning. Francine?
Yeah, I'm looking at VIX, Tom. Overall, stocks in Europe are climbing, led by miners. S&P futures also rising. Look, if you look at the dollar's decline, it supported commodities with metal higher, crude oil halting a six-day sell-off, which is why I'm looking at crude over NYMEX at $60.33, Tom.
Very good. Let me look at Lehman lows, but not the equity bull market. I had a straw, Kathy Fisher or George Bory, and I decided we look at the bond market here. This is the Bloomberg Barclays U.S. Total Return Index. Here's the Lehman low, which is an equity kind of thing, I guess. And here's a terrible bond pullback. Another terrible bond pullback. Another terrible bond pullback. And this is the little teensy-weensy rollover we've seen so far. We need to put things in perspective. Francine?
Yeah, this is my perspective. This is an S&P 500 chart bringing it back to 2004. Now, every time there's a red circle, and I will push it out for people listening on London DAB Digital, and good morning to you. Every time there's a red circle, that market pullback was around 5%, if not more. And you can see it's from June, Tom, I say June of 2016, that we hadn't had such a pullback.
Yeah.
And of course, the week that was last week, well, we know when that happened, but nothing from last week until, or, since June of 2016.
Very good. Very, very smart chart. What we need is some perspective. We are thrilled, as I said out on Twitter, what a set of guests we've had over the last 10 days. We've tried to match people up to drive an intelligent conversation forward. We continue with that. Kathleen Fisher is with AB Bernstein, head of their wealth investment strategies, dispensing of aspirin. George Bory's at Wells Fargo, where he still has his job as head of credit strategy. What a week. I mean, just what was your thought, Kathy, over the weekend as everybody tried to disengage for 12 hours?
In all honesty, I was impressed at how calm our clients were. And the reason for that is that I think we and most strategists had been saying all through the fall and certainly into January that the market had been too good and too calm. If you look at risk-adjusted returns in 2017 for the S&P, they were among the best ever because returns were so strong and volatility was so low. It was off the charts in terms of a Sharpe ratio or any of the standard metrics. It was too good to be true. It could not last. And therefore, people did not expect it to.
This Monday morning, your world is in the crosshairs. Should I look at full faith and credit down 5, 6, 7% in price? Or do I look at a blended index down less, 2 or 3%, with corporates doing better?
Yeah, the bond market's clearly under pressure. I mean, that's really been the leading edge of the down trade. People are very worried about a big risk-off trade. But in our opinion, this is a duration-off trade. The last 10 years, people have been adding duration to their portfolios in all sorts of fashions, at the front end of the curve, the long end of the curve, and even in equities. And right now, with the prospect of tighter monetary policy, and as you point out, Tom, yields just starting to creep higher, you're at risk. Bond prices are at risk as bond yields move up, and that's what investors are trying to hedge right now. So corporates give you a little bit of cushion against that, but it doesn't make you immune to those risks.
Right. So, Katie, is there a way of hedging? I mean, do you think that there's going to be a route when it comes to credit? And if you do think it's coming, how can you be the first one to spot it?
So I think is that for me? Sorry.
It was to Katie, but go for it.
Okay, sorry. For bond markets, I think the quick and easy answer is you look at variable rate securities. Things like loans or leverage loans do very well in this kind of environment because they're repricing with interest rates as front end yields come up. And if you look sort of year to date, they've been by far one of the better performing assets. And I think are going to continue to do well. We'll probably talk about how well the economy is doing, and companies are well positioned to continue to perform, to continue to pay their debt service. But the floating rate structure of a loan or a loan fund can be very beneficial in this kind of market.
All right, Kathy, sorry, I Britishized your name into Katie. Kathy.
Yes.
So thoughts on that? Do you see a turn in the credit market?
So we were talking earlier about the fact that this whole crisis started in large cap U.S. equities. And as the week went on, credit markets became a little more ruffled. I think the real issue that equity investors are grappling with is the fact that clearly rates are rising now. They've been looking at rates rising for a long time. It hasn't happened now. It does seem that they are. And clearly, as George said, having variable rate instruments, having floating rate bonds is very helpful at a time like this.
Within this is the theory. I believe there's a foundational theory to what we're doing here with our money. Kathy, let me start with you. On the efficient frontier, which is a loopy little line and a fair amount of parabolic math to it, it's either 60-40 or 60-30-10, whatever it is. Am I going to get killed on the efficient frontier if I own bonds?
Remember, time horizon matters a lot. It depends what your time horizon is. If you're looking to have bonds diversify you against the volatility of stocks over time, you know there will be periods where bond returns will be quite muted, as you showed on your chart. Bonds can go down, but they go down small amounts.
Right.
So the issue is, why are you holding bonds, right? And on the efficient frontier, it's usually because bonds are giving you that ballast against the volatility of stocks. If you have a shorter time horizon and return matters a great deal, then indeed you're better off having something with more return potential.
But then, George, in your committee meetings with asset allocation, you're under the desk hiding with a hard hat on, and they're all spouting theory about efficient frontier. What do you advise asset allocators when price is down? What do you do with the efficient frontier?
Well, I think if you're looking at bonds specifically, I think you want higher yielding securities. You want to be able to compound at a higher rate, and you want your cash flows coming back to you as fast as possible. So those variable rate structures are very friendly. But also right now, we've seen a dramatic repricing across different parts of credit markets. So very short dated 1, 2, 3 year high yield bonds at say 4 to 5 to even 6.5%, very attractive.
This is really critical, Francine. The idea of buying garbage, you know, I'm exaggerating, but I'm allowed to. I've got a striped suit on. If you're buying garbage, you buy it in short maturity to grab that big coupon.
All right. I don't know what you're talking about, Tom. Garbage or no garbage. George,
it's level 4 CFA.
The one thing that you would, yeah, it's even level 5, but not on a Monday, Tom. Give me a break. George, what would you not buy in this kind of market?
So I would be very careful about, super long duration. That's where you have the most amount of price sensitivity. As Tom pointed out before, bond yields are moving higher. You could make an argument that maybe we'll stabilize in here. The government's borrowing a lot of money. There's a lot of upward pressure on yields right now. And although the moves have been relatively small, those price impacts can be very, very significant.
Yeah.
So out at the long end of curves, whether you're a muni investor, a corporate bond investor, or a government bond investor, you should think about hedging some of that risk.
Very quickly, a single point VIX where Kathy Fisher says all clear. Is it the average 2019, or do we have to go even lower than that?
No, I think we're going to have a higher VIX for the next foreseeable future. I think this incredibly low period of VIX is behind us now. And we should be more in a normal level. There's many reasons to expect more volatility. So more normal is absolutely in the cards, maybe a little above normal.
This is fabulous. Terrific, timely briefing here on a Monday morning. Kathleen Fisher with A.B. Bernstein and George Borey of Wells Fargo. Coming up on Bloomberg Daybreak, a conversation with the laureate of Yale. We saw him at Davos. Robert Shiller. Too much to talk about with Robert Shiller, including adjustments in the P in the numerator and the E in the denominator. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance. I'm Taylor Riggs. Let's get the Bloomberg Business Flash. In the UK, Barclays operating unit faces a new criminal charge over its controversial capital fundraising at the height of the financial crisis. The Serious Fraud Office accuses Barclays of unlawful financial assistance. It has to do with a $3 billion loan the bank got from Qatar back in 2008. 4 former executives in the bank's holding company had already been charged. Barclays says it will defend itself. A private equity firm and a Dutch pension fund are making a joint bid for AkzoNobel's specialty chemicals unit. That's according to the Financial Times. The FT says that the pension fund, PGGM, would be a minority co-investor alongside Apollo Global Management. The Akzo unit could be valued at more than $12 billion. And a new deal will ensure that Airbus keeps producing its A380 Super Jumbo for at least the next decade. Emirates has signed a contract for another 20 of the double-decker planes. The deal has a list value of $16 billion. Last month, Airbus said the A380 program could be terminated if there wasn't a new sale soon. And that's your Bloomberg Business Flash. Francine, Tom.
Taylor, thank you so much. It was, to be polite, an eventful weekend for Washington. There were any number of spins on Sunday. From Chris Wallace's Fox News Sunday, here is Mick Mulvaney.
I think all the stories about replacing General Kelly are mostly being fed by people who are unhappy that they've lost access to the president under General Kelly's leadership as chief of staff. So, no, I'm extraordinarily pleased with the job the chief has been doing. Everybody in the West Wing is.
Mick Mulvaney on Fox News Sunday. Kevin Cirilli joins us right now. Kevin, I don't know where to begin on a Monday after what we saw this weekend, but what we really saw was a quiet president. He wasn't all that visible. Why is that happening?
Well, we also heard from President Trump on Twitter, kind of still weighing in on this controversy that many folks up on Capitol Hill are wondering why he would engage in this controversy. Look, I think from Director Mulvaney over the weekend, you heard what the White House is really suggesting, and I think that there is a frustration that former aides to President Trump who have been shut out of the president's inner circle are getting some type of political retribution on this. The question becomes, look, this week the president wants to focus on infrastructure. The Congress is set to begin debate on immigration. There's really important issues being debated outside of this. And why the White House is continuing to trip up on this is kind of baffling.
Well, I'll go with that, and I'll also go with what you're expert, which is the distance between 1600 Pennsylvania Avenue and Capitol Hill. I believe we have a Republican in the White House and a Republican Senate and a Republican House. And yet, how far apart are they on this Monday in February?
Well, with regards to the Rob Porter issue, very far apart. I mean, it's quite, whatever adjective you want to use, questionable, to put it mildly, why the White House's response on this has been so tone deaf, again, putting it mildly. There's frustration on that front, particularly when this is the day that they're set to launch an infrastructure plan that deficit hawks are going to be scratching their heads and grabbing their calculator for, because the math as of right now just doesn't add up.
Kevin, talk to me about South Korea. How's that being taken, or even North Korea? We have Olympics in Korea. We heard, for the first time, the North, the leader sending his sister to an overture to the Vice President of the United States. Is it kind of like, is peace looming, or is this just optics?
I think a little bit of both, Francine. I think that Vice President Pence over the weekend remaining seated during North Korea's march into the opening games, that was widely praised as a show of statesmanship, of leadership on behalf of the vice president. We should note that Otter Warmbier's parent was accompanying Vice President Pence as well, another strong showing of the United States for the support of the Warmbier family. We remember that they were the guests at the State of the Union address. Look, the last time this happened from a historical perspective was in the early 1990s, the Clinton administration during those Olympics, when North Korea, quite frankly, received money for playing along with South Korea. We don't know what their motivation is at this point to be attending these games, but I can tell you that folks in the intelligence community and in the national security community on both sides of the aisle feel that talk between North and South Korea is a positive, but there's a lot of skepticism for their motivations.
Okay, so what's the next step in this, Kevin? And how much does the Trump administration actually focus, I guess, on a possible win with Korea to also distract from domestic issues?
Well, 2 points that I'd make. First and foremost is that President Trump's approval ratings in South Korea are incredibly low. There's a mistrust of the United States in South Korea. Now, the second point that I would make is that because of that mistrust, the South Korean government is facing pressure to really work with China on the issue of North Korea. And so with regards to the Chinese, whether or not they're going to be able to continue to place the more intense economic pressure on dictator Kim Jong-un, that's really the angle that the United States would like to see. But again, from a broader standpoint, the overall skepticism of North Korea, particularly during these Winter Games at a time when, historically speaking, their missile tests increased during the spring, we're just around the corner from that, Time will have to tell.
Kevin Cirilli, thank you so much. Greatly appreciated. Our chief Washington correspondent. We're going to come back with Kathleen Fisher of A.B. Bernstein and George Bory of Wells Fargo. They want to talk about maybe what you do or actually what you don't do with your money. Coming up, James Messina. He is former Deputy White House Chief of Staff for President Obama. This is Bloomberg. Futures up 30 right now. Kathleen Fisher with us, Francine LaQuad London. I'm Tom Kinnear. Kathleen Fisher with us with A.B. Bernstein. George Bory with us as Wells Fargo. Let's look at the carnage of fixed income. And on a short-term basis, bring up the chart here. Apple and Swiss francs debt down $2, make it $3. Oh, that's terrible to make 0.75% yield in Swiss francs. But George, the point is from the peak of a summer and a half ago, this puppy's down 10%. I mean, which is it for corporate bonds? Do I want to grab a small coupon? Is this a better place to be?
Well, I think corporates, the redeeming value of corporates is that little extra spread you get over treasuries, which can be beneficial, certainly if it's held in a much bigger portfolio. But the important component to that is being able to either utilize the long duration or hedge it. Because as you point out, the price sensitivity is huge. Yeah. If you've got a 30-year bond with a 0.75% coupon, rates go up just a little bit, boom, you're down 10%. Down. And that's not what a typical retail investor is really in it for. Maybe a pension fund manager or an insurance company. But that price sensitivity is exactly what the market is trying to run away from right now.
And now the only question of the morning to Kathleen Fisher. Is dividend growth a substitute for the humanity he just described?
I think that's a really interesting question because I think one of the things you're going to see as markets get a little jittery is people who had gone to dividend-paying stocks to replace the yields they were not getting on bonds will start to rotate out and go to bonds that are giving them the coupons they need. So rising rates are going to create many sort of unintended consequences like that, and I think we're actually starting to see a bit of that already.
I mean, in the utilities as well. We've got some technical people say buy the utilities here on the pullback. Do you acquire traditional electric utility shares here on pullback? Yeah. Are you brave enough to do that?
Yeah, I think that is not a brilliant strategy because people will be looking for bonds instead of utilities as rates start to move up.
This is exactly, folks, why we love having these two on, this balance between a fixed income world and an equity world, and particularly this after an 8, 9, 10-year bull market as well. Kathleen Fisher with us with A.B. Bernstein and George Bory, Wells Fargo. Much more to talk about. We're going to touch on oil as well. Coming up on Bloomberg Surveillance on Radio, a timely conversation. The Republicans deliver big budget deficits. Jared Bernstein in the 8 o'clock hour. This is Bloomberg.
Good morning, everyone. This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, this is what I'm looking at. Quite a lot of action in the market, Tom, but definitely subdued compared to the volatility that we saw last week. European stocks now seeing a gain. I wanted to show you also U.S. futures, because that's probably the inflection point that we'll watch for in the market. For the moment, they're still advancing. The dollar and treasury is falling. There is a little bit of concern, Tom, as you were saying, that Donald Trump's budget proposal will drop his party's goal to balance the budget in 10 years. And so you're seeing a little bit of an impact on treasuries. Now let's get straight to the Bloomberg First Word News. Here's Taylor Riggs. Hi, Taylor.
Francine, Tom, South Africa's ruling African National Congress meets later today to finalize the transition in power from President Jacob Zuma. ANC leader Cyril Ramaphosa has told supporters that the party must resolve its problems, including accusations of corruption against Zuma. Ramaphosa replaced the president as ANC leader in December and is expected to succeed him in the presidency as well. The Trump administration is signaling a policy change on North Korea. Vice President Mike Pence says the U.S. is ready to engage in talks on Kim Jong-un's nuclear weapons program. According to the Washington Post, Pence and South Korea's President Moon Jae-in agreed to pursue dialogue with North Korea during the talks at the Winter Olympics. Pence says the U.S. will keep putting pressure on North Korea. President Trump may struggle with that promise to spend $1 trillion to fix the country's crumbling infrastructure. The plan he rolls out today commits the federal government to spend only $200 billion. The funding would be used to spur local governments and the private sector to come up with the rest of the money. Democrats call that bait and switch. In Russia, investigators are trying to figure out why a passenger jet crashed not long after taking off from Moscow. All 71 people on board were killed. The plane belonged to the regional carrier Saratov Airlines and was on a flight to the city of Orsk. And British Prime Minister Theresa May is starting a drive this week to end the Conservative Party's civil war over Brexit. Senior UK ministers will deliver a series of speeches setting out a vision of life outside the European Union. Conservatives are split between those who want to retain close ties to the EU and hardliners who want a clean break. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Tom, Francine.
Taylor, thank you so much. Now, WTI has rebounded to trade around $60 a barrel after tumbling 9.6% last week, while oil is rebounding from its biggest weekly decline in 2 years, while a surge in U.S. shale still looms over the market. Let's get straight to Stephen Shork. He joins us now on the phone, and he's the Shork Report editor. Great to have you on the phone. Thank you so much for joining us. Stephen, talk me through what kind of range you see for the price of oil. 2-3 weeks ago, we were saying, look, OPEC has cleared the market. This agreement between Saudi and Russia was enough to actually curtail some of the proposed oil. But now it seems that shale, once again, at the forefront.
Well, absolutely. The crude oil bulls in this market for the last 3 years have always tried to downplay or simply ignore the rise in North American oil production. So even from November 2016 to November 2017, the last month for which we have the monthly data, we have the absolute fact that U.S. production, shale growth production, has outpaced the decline in OPEC production by 7%. So there's actually more oil being put on the market by the U.S. than there is being taken off by OPEC. So essentially, we're in the midst of the correction. Last week, or the year-to-date high is just around in the mid-60s. We're looking now at the new range. The paradigm has changed over the last 3 years. We were essentially looking at a market that was bound in between the mid-50s on the high end to the mid-40s on the low end. I'll venture that we've moved $10 higher now going through to the new year. That is to say that the high in the market is looking around to be in the mid-60s. The low in the market, well, if the previous resistance was in the mid-50s, then today's support would be in the mid-50s. So we're looking at a market likely range bound in between the mid-60s to the mid-50s to low 50s in the new year.
Stephen, how is that driven by dollar? So, of course, a weaker dollar drove oil's advance in January, but then it rebounded a touch.
Yeah, absolutely. The dollar is extremely important. A very strong correlation between and an inverse relationship between the dollar, given that the dollar is the world's invoicing currency. So we've had a lot of issues over the past few weeks with the Secretary of Treasury seemingly advocating a weaker dollar policy. This was the same policy that was pursued 15 years ago, and it was a policy that undoubtedly led to the spike in oil prices. That is to say that if you are a producer, you do not want to be paid in a currency that is being kept artificially low by government fiat. So if you keep the dollar low, you actually stiffen the resolve of OPEC and Russia and even the United States to keep production off of the market because you need to earn that income. But if you do have a stronger dollar, that does ease the pain. So the Federal Reserve, the Secretary of Treasury, will be just as important to the direction of oil prices as OPEC and producers here in North America.
Stephen Shork, you write the definitive micro-analysis of hydrocarbons. I congratulate you for getting Nick Foles of the Philadelphia Eagles into your report this morning. Only you would do that. You are definitive on demand dynamics. When you hear the media talk about increasing demand, when you hear fundamental oil guys talking about increasing global and U.S. demand for hydrocarbons, how do you respond?
There is absolutely, thank you, and there's absolutely room for the upside. What we've experienced in the past now is demand for gasoline, and of course this is what's going to drive oil prices, is inelastic up through $65, up through $90 a barrel. So that is to say that there is certainly room for oil prices to move higher without having a significant impact on demand. Once we get above $95 a barrel, now we're talking about gasoline prices in the United States approaching $3.30, and that's when demand begins to fall off.
Let's summarize that, folks. If gasoline, we need our gallon of gas to get to work, to do business, etc., and that pushes oil up to the headline making $70, $80, $90 a barrel. Stephen Schork, what is pushing against the reality of that buoyant Trump-like demand?
Well, what's pushing around is actually the producer does not want to see, or if they're intelligent enough, they do not want to see oil prices much higher than where we've recently been, that is to say in the mid-60s, because for the first time ever, the oil producer now has to compete. There are substitutes now in the market. There are electric vehicles, there are hybrids, and so forth. So when we begin to push oil prices beyond where we've recently been, you're now lowering the entry barrier for those substitute fuels into the market, and that's increased demand. And once you allow that to happen, you're not going to go back. The genie's already out of the bottle. What the producer now has to do is to try to limit how much that substitute impacts the market. So the higher we go, you're actually hastening the demise of the hydrocarbon economy.
But Stephen, are you worried about, or worried or not worried, but is there chronic underinvestment in the oil landscape? And if there is, could you see a spike up to then 110, 115 in a couple of years?
No, I don't think that is absolutely possible right now. To your point, it's an excellent point that with the pullback in oil prices over the last 3 years, we have seen a significant pullback in CapEx. But that said, we've had a very nice rally since the second half of last year. Producers are in much better position. We can say this with a high degree of confidence because the amount of hedging, the amount of the ability of where producers have sold forward, they're obviously very comfortable with prices at this level, and there is a very strong relationship, 95% confidence that the rise in oil prices, when you juxtapose that to the 4-month lag in oil rig counts, it just means that oil rigs are just going to continue to rise well into the second half of this year.
Got to leave it there. Stephen Schork, thank you so much, from the home of the Philadelphia Eagles this morning, editor of the Schork Report as well. Kathy, I just looked up a French oil company, Total, 5.43%. Boy, some of the big oil yields are attractive. Are you overweight oil? Are you range bound where you really don't care whether it's European oil with a big dividend or American oil? Where's the mood on that?
Well, we're not making a big bet on oil stocks. Each company is very different, as you know, and therefore what each company is doing in light of a lot of change is really important. Clearly, reserves in the ground are no longer worth as much as they used to be. Companies are dealing with that. So it really is a company-by-company situation. We're not jumping in and thinking there's some massive opportunity here, but rather how is each company dealing with a very different environment for oil than we've seen before.
Kathy, when you look at the Saudi Aramco IPO, I know there's still questions on whether they will be listed internationally or not, when it will happen this year, but is that a real game changer for investors?
I don't think so. There's a lot of politics, obviously, there, and what's the reason that's happening. So I think the valuation will matter a great deal, but it's not going to affect the dynamics of what each company is doing in its own space, and that's really what matters when you're a stock picker.
I am looking at the Total bond. If we have time, we're going to come back with George Bohr. I'm sure it's not a bond he's looked at, but you get paid less than 1% from Total for 10 years, and the price has gone from 98 to 95. Wow, that's sporting, to say the least. We've got a great equity chart to put your stock market in perspective. We're going to do that in a bit with Kathleen Fisher of AB Bernstein and George Bory of Wells Fargo. Don't forget your morning briefing on radio. Bob Boone, Karen Moscow, Bloomberg Daybreak, coast to coast and worldwide. Radio London, too. This is Bloomberg.
This is Bloomberg Surveillance. I'm Taylor Riggs. Let's get the Bloomberg Business Flash. 4 years ago, Blackstone Group sold New York's Waldorf Astoria Hotel to China's Onbeng Insurance for a record price. Now the firm may get the chance to own the landmark again. According to people familiar with the matter, Blackstone has had talks about bidding for the Waldorf and other Onbeng assets. The sale is being overseen by China's government. Oil prices are rising today after their worst week in 2 years. That's good news for Siemens. The engineering giant says a number of projects were delayed when oil prices collapsed. Bloomberg spoke to Siemens CEO Joe Kaeser.
Now with the oil price being, let's say, 60, 70, and a very disciplined management of, let's say, OPEC and associated oil countries, I believe that this will re-accelerate the projects going forward.
And Comcast may make another bid for much of 21st Century Fox 2 months after Fox agreed to a deal with Disney. According to a person familiar with the matter, Comcast originally offered $60 billion, which was higher than Disney's successful bid. Disney agreed to buy Fox's movie and TV production house, a lineup of paid TV channels, and a 39% stake in Sky. And that's your Bloomberg Business Flash. Tom, Francine.
Tara, thanks so much. Now let's stick with that last story. And for more on the potential bidding war for Fox's assets, we're very pleased to be joined by Aaron Kirchfeld. He's the executive editor for Bloomberg's Global Deals team. Aaron, thank you so much for coming on. So first of all, why did Fox actually agree to a sale of assets to Disney? Although we understand that Comcast may have offered a higher price.
Yeah, that's right. That's the question everyone's asking. Right. Usually it's all about money and it comes down to price. But in this situation, I think the Murdochs, they examined the both deals from Disney and Comcast, and they came to the conclusion that regulatory-wise, it would be easier to get the Disney deal through. And also, I think they liked the structure because that left Murdochs with some shares. So they see the upside in the Disney story, and also possibly James may get a job at Disney down the road. So I think that was appealing as well.
Okay, Aaron, usually, right, so you decide to merge, but then there's a huge breakup fee. So then I back out, I get cold feet for whatever reason. How much does Fox have to pay in this?
So if Fox backs out of this, they would have to pay $1.5 billion. So a pretty hefty sum. And if there's a regulatory issue, if the regulators block the deal, then I think it's something like $2.5 billion. So there's a big price tag if this deal falls apart. That said, if you believe the reports from people familiar that Comcast offered $60 billion versus $52, obviously that's a bigger bridge, gap to bridge, and that would make up for the breakup fee. So hence, I think the idea that Comcast could come back, some people are really watching it closely because the money is there if they want to pay it.
So what's next? So we think that Comcast basically offered a lot more, but where does that leave, for example, the jobs for James Murdoch?
Yeah, so I think at this moment, the big question is thinking about things and doing it. It's a big difference. So I think Comcast is deliberating this. Look, there's some very attractive assets that Fox sold to Disney, including Sky here in the UK, the paid TV program, which Comcast was very keen to get, according to people familiar. So I think what it comes down to now is Comcast will look at this closely. If they go ahead with a bid, which remains to be seen, how big will it be? What kind of termination fee will they offer? Yeah. Would it be enough to get Fox and Murdoch back to the table?
Yeah, but the issue here is it's a bunch of families warring, Aaron. What's a Class A, Class B structure here? I would suggest the shareholders really don't have any voice in this, do they?
I think definitely the Murdoch family is the driver here, and it will come down to them. It will come down to chemistry between him, the leaders at Disney, the leaders at Comcast. So you're right. It's not just about money. It's not just about, financial structure and data. I think it does come down to personalities, chemistry, and I think in that sense, Murdoch made their preference clear when they went for Disney. But obviously money talks, and so it remains to be seen what could Comcast come back with.
Very good. Aaron, thank you so much. Greatly appreciate it. Aaron Kirchfeld with us as we look at one of the media deals. The one that really caught my eye was Hulu. Hulu and their challenges at making money. Let me tell you about TV Go right now. Real simple. If you're at your desk at AB Bernstein or Wells Fargo, you can get briefed off of the good work of Kathleen Fisher and also George Bory. Even better, you can come over and grab this gorgiosity here, bring it over, and you can steal that chart over so you can dazzle George Borey at your 11 a.m. meeting in New York. This is Bloomberg. Looked for Noah's Ark Sunday morning. That's how much the rain was in greater New York. We have clear skies today. It literally looked, Francine, out my window Sunday at about 10 a.m. like London in about 1830. It was that gloomy. But we are ungloomy here this morning. A beautiful New York. We say good morning in London, in New York, worldwide to all of you. And with us, George Borey of Wells Fargo and Kathy Fisher is with us of AB Bernstein. Two people who I would suggest counsel perspective and patience. Let's look at a single best chart, which at least says, where are we? We're not going to do the silly parlor game of guessing. The Dow, we showed this last week any number of times. OMG, down we go, right on the 10% correction. And this is the teensweens bounce that we see this morning. 1987 down here. I didn't go to the John Madden School of Telestrator for anything. And this would be down here, the 1929 big decline as well on a percent basis. Kathy, what do you make of this? You look at the technical construction, every client asking you about this. What do you do at a 10% correction level?
Well, first of all, a 10% correction is a very normal correction.
Yes,
it's not
thank you.
extreme. 10% corrections happen roughly every year and a half or so, so this is no big deal. We needed a correction from the very lofty levels the market had gone to in January in particular. We couldn't tell whether it would happen as the air going out of the balloon or a steep decline.
Yeah.
We had a steep decline. And when you think about it, there are a lot of new things in the market. For example, we've read a lot about ETFs and ETNs, the inverse ones, the levered ones. We didn't have as many of those in the great financial crisis. We didn't have as much assets in those. So these things can happen quickly when people unwind those trades. And we should expect probably more of these short, sharp pullbacks from time to time.
We have different people on surveillance. Thank you, Doug Cass, for being with us on Friday, the trader, talking about much more short term. How do people at Wells Fargo or at AB Bernstein, Kathy Fisher, how do they shut out the trading noise? It's there. It's part of the game. It's part of the pulse of Wall Street. You've always got to be saying, this is my timeline, right?
Time horizon of your assets
is everything.
Is what matters. Remember, if you are investing for the next 30 years, this is a tiny blip along that journey. If you're going to use money to buy a house a year from now, it matters a lot, and you shouldn't be in equities, right? So the time horizon of your assets should dictate how much of the short-term noise you pay any attention to whatsoever.
George, let me ask you this question. If there's something, if the wind turns in the credit space, where would it start?
So I think where you see the most amount of pressure, there's kind of two edges to this. One is just simply at the long end of the curve, and we have seen a material increase in volatility. I like to call the long end of the curve, it's adult swim only. You buy long bonds for a very specific reason, one of which is the yield. The other is duration. And so institutional investors, pension funds, insurance companies, they will buy those bonds because they're being put in very specific portfolios. The other end of the spectrum, at the front end of the curve, is starting to show a fair bit of volatility. Two-year yields are up pretty dramatically as Fed expectations continue to work their way into the market. So we've seen a little bit of a dislocation at the very front end of the curve. And it's that sort of barbell, if you will, that would tell you, there's a major change going on in the bond market as interest rate expectations start to adjust. Some of that is now looking pretty fully priced, so the front end is actually looking relatively attractive. Whereas at the long end of the curve, we've had big price moves, but the actual yield changes are still relatively modest by historical standards. So, we would suggest people continue to move down the curve, try and focus towards the front end, and really maximize your yield with the shortest duration possible.
But George, what about the German bonds, right? And we have quite a lot of guests here in Europe saying if there's a violent repricing of German bonds, that's a game changer, and no one is really focusing on it so much.
Well, I think that's a very good point. I mean, the ECB does hold some magic keys right now. And so, to the extent the ECB decides to sort of dial back its own purchase program further as the year unfolds, so that certainly puts bunds right in the crosshairs. And a material increase in bund yields, would have some very dramatic price implications. And as I mentioned before, there are two different types of investors. The institutional investor on one hand, who can weather price volatility. Then there's the retail investor, who's really not in it for price volatility. They want sort of coupon, they want income, but they're not really expecting big price swings. Well, with yields so low, you are getting very big price swings, and I think that is particularly true in Europe and puts the European retail investor kind of right in the crosshairs of this bond volatility.
This is exactly what we wanted. Thank you so much. We're going to continue this on Bloomberg Radio with George Bory and Kathy Fisher, but just what we want, sane discussion about where we are in these cross-asset markets. Stay with us all day from London, from New York. This is Bloomberg.